Ladies and gentlemen, may I once again ask you to please settle down so we kick off with our program. Thank you. The Governor of the Bank of Namibia, Mr. Epson Wanguta, Deputy Governors of the Bank of Namibia, Ms. Leonie Dan, former Minister of Mines and Energy and former Governor of the Bank of Namibia, Honorable Tom Alwendo, senior representatives of government present, board members of the Bank of Namibia present, chief executive officers, managing directors, and senior representatives of the banking sector and financial sector at large, senior representative of the oil and gas industry, esteemed international guests, distinguished speakers, presenters, and panelists, members of the media, ladies and gentlemen, good morning. My name is Jason Kaindume from the Bank of Namibia, and I have the distinct pleasure and honor to serve as the Director of Ceremonies for today's proceeding. On behalf of the Bank of Namibia, it is therefore my absolute pleasure to welcome you to this important seminar under the theme, Positioning Namibia's Financial Sector for a Sustainable Oil and Gas Economy. Namibia at this point in time stands at a very pivotal point in its economic journey. Development in our emerging oil and gas industry have created considerable optimism regarding the country's future and development. However, the opportunities before us, colleagues, also raises important and practical questions. Is our financial sector, including banking institutions, non-banking institutions, and capital market, are they adequately prepared to support activities across the oil and gas industry and value chain? Do our institutions possess the specialized knowledge and the risk management capabilities required to participate responsibly? How do we meaningfully ensure that local participation is building the necessary capable and capacity, bankable and competitive Namibian enterprises? And how do we pursue these opportunities presented by this emerging industry without compromising financial stability, fiscal discipline, or the diversification of our economy? These, ladies and gentlemen, are not questions that can be answered by one institution or one sector alone. Today's seminar, therefore, brings together government, it brings together regulators, financial institutions, industry participants, and other stakeholders to share not only experience, but also identify capability gaps and consider the partnership required to position Namibia appropriately. Our program has been deliberately designed to provide different but complementary perspectives from national policy and regulatory preparedness to financing structures, local participation, and Uganda's regulatory and supervisory experience in preparing its banking sector for the oil and gas value chain. My responsibility this morning is relatively straightforward. It's to really guide us through the program, keep the discussion focused, and perhaps more ambitiously, keep us all on time. Before we proceed, just a few housekeeping announcements. Kindly ensure that your mobile phones are placed on silent mode. For your comfort, the restroom facility are situated just on your left if you leave the conference room. And lastly, the parking tickets can be validated at reception when we leave. Ladies and gentlemen, at this juncture, it's just fitting that we start off with a keynote address. Our keynote speaker brings a particularly valuable perspective to today's engagement. Honorable Tom Alwendo is a Namibian economist, former cabinet minister, and a central bank governor, author and business leader whose career has spanned monetary policy, national development planning, mining, and energy. He began his senior public service career in 1993 as the deputy governor of the Bank of Namibia, and in January 1997, he became the first Namibian to serve as governor of the central bank. During his tenure, he contributed to the consolidation of the Namibian dollar, the localization of the country's payment and banking system, and the establishment of the Financial Intelligence Center. Following his departure to public office, he founded Alvenco Energy, a Namibian company participating in the energy sector and providing strategic advisory services in energy, mining, investment, and public policy. He is the author of System Over Symbols, looking at rules, records, and quiet governance, which examines the importance of credible institutions, effective system, and sound governance in national development. Please join me in welcoming Honorable Tom Alwendo, former Minister of Mines and Energy and former Governor of the Bank of Namibia. Honorable, the floor is yours.
Thank you very much, Jason. Did you just call me honorable? I didn't know that I still deserve their title after I left public office. Governor Wanguta, deputy governors, system regulators here, the leaders of our banking and financial sectors, industry representatives, ladies and gentlemen, good morning. But Jason, I didn't know I was actually the first one on the program. What happened? But good morning. I'm quite happy to be here and then to thank the Bank of Namibia for having invited me to be part of this important seminar. I really think it's a very, very important and necessary seminar. But when I got the invitation letter first that came to me, I was pleasantly surprised to receive that invitation because after leaving public office, one does not always expect to get an invitation by institutions, especially those you worked for before. In fact, when I saw the letter, I thought maybe the bank wanted to ask something which I didn't do, or maybe I did do before I left the bank. But when I read the letter again, actually it was about to give remarks at this important seminar. Now, I am here today to really be grateful and actually ready to speak about a subject that matters deeply, I think, for all of us. Jason say, it's a subject matter that is important for our future as Namibia. And to start by saying Namibia is already standing at a new frontier because for years, a number of years since independence, oil and gas lived in the language of possibility. It was only possible. Where we studied seismic data, where we issued licenses, where we watched companies that were doing exploration, and always hoping that one day the geology beneath our ocean would confirm that we have oil and gas. And I think we can now say that that day has arrived, because the oil discovery have changed the national conversation. They have raised expectations in our towns, in our villages, in our boardrooms, and in our public institutions. They have created hope. But we need to understand that hope by itself does not build an economy. A discovery is not yet a development. A resource is not yet prosperity. And a license issued to an oil company is not yet a livelihood. So the distance between discovery and development is not traveled by geology only. It is also traveled by institutions, by capital, skills, discipline, and trust. And that is why I believe that this seminar matters. We are not here to merely ask whether Namibia has oil and gas potential. That question is being answered beneath the ocean. We are here to ask a more demanding question, and that is, will Namibia have the financial architecture, policy clarity, supervisory readiness, and institutional courage to turn that potential into sustainable national value? Now, the word sustainable, that is in the theme of the seminar, is very important. It's not only about the environment, although environment is important. It is also about financial, institutional, and social sustainability. Prudent finance, for example, predictable policies, real local participation, and benefits that strengthen Namibia beyond only a single project. So I speak today with respect for both sides of this discussion. As a former governor of the central bank, I know that banking is built on prudence, where banks do not lend because a sector is fashionable or because the country is excited, or perhaps because a project carries national emotion. Banks lend on the basis of risk, capital adequacy, governance, and repayment capability. That discipline must not be weakened. But also, as a former Minister of Mountain Energy, I also know this. When a country discovers a strategic natural resource like we did, it cannot and should not afford to be a spectator in its own development. Therefore, a nation must ask, who will build capacity? Who will finance local participation? Who will prepare our local companies that we need to have? Who will ensure that our people are not only watching ships offshore, but building businesses onshore as well? So today, ladies and gentlemen, I do not ask our banks to abandon caution. I ask that caution must not become absence. I do not ask policymakers to force lending. I ask that policy must create the conditions under which responsible lending becomes possible. At present, Namibia's oil and gas sector is largely financed by foreign capital, and understandably so, because upstream oil and gas is capital intensive, technically complex, foreign currency based, and exposed to long timelines, geological uncertainties, commodity price risk, and environmental responsibility. And as we know, our banking sector was not built around offshore oil development. Our banking sector was built around the economy that we have had: household mortgages, installment finance, trade, and the conventional commercial lending. And I must say that that model has protected stability and supported growth in the country. But the economy before us is changing, and the real question is whether our financial system will change with it. If local banks and other financial institutions remain outside the oil and gas sector, the financial value chain will indeed be captured somewhere else. For example, advisory fees will be earned elsewhere. Project structuring will happen elsewhere. Local companies may win contracts on paper, but fail to deliver because they cannot obtain working capital, they cannot obtain equipment finance, guarantees, or insurance support. And then if that happens, we will face a painful contradiction where Namibia will have oil activity, but limited financial participation. And I believe that we must not allow that. Now, for the ordinary Namibian, the oil and gas question is not technical, as it might for some of us. It is deeply human. For the young graduate in literacy who wants to know whether this industry will create a future for her. The small business owner wants to know whether he can supply services without being crushed by lack of finance. The welder, the engineer, and the marine technician want to know whether this national resource will indeed improve livelihoods. Now, these expectations might be high, and some might even be unrealistic, but they are legitimate. People are asking a fair question, and that is, will this opportunity belong to Namibia, or will it merely pass through Namibia? That is the question that we must answer through action, but we must also answer it wisely. Because oil and gas can create wealth, but it can also create or destroy capital. A poorly structured transaction does not become safe because it carries the language of local content. A weak company does not become bankable simply because it is close to an opportunity. Equally, a bad loan does not become developmental simply because it is made in a strategic sector. So the real task for us is not to make banks less prudent. It is to make the sector more bankable, and that is the bridge all of us must build. On the one side of that bridge is global oil capital. That's experience, is mobile, and very demanding. And on the other is Namibia's development ambition. We need jobs, we need skills, we need to build local firms, we need public revenue, infrastructure, and industrial growth. And between the two stands our financial system. And if that bridge is weak, foreign capital will come, and indeed it will come, extract what it needs, and leave limited local capability behind. It is, if it's strong, foreign capital can become a partner in our domestic development. And that is why the financial sector matters very much. Not because local banks must finance everything, because they cannot. Also not because they must take exploration risk. I would say they need to be careful. Not because they must replace international capital, because they also cannot, but because banks and other financial institutions can help turn contracts into companies, companies into employers, employers into taxpayers, and taxpayers into a stronger nation. Now, for local banks, the opportunity should be approached in layers. Now, I see some bankers here that you might say, but what does he know about this, about banking? I can see somebody's looking at me like, it's only my suggestion. And the first layer is supplier and contractor finance. This is the most immediate and practical entry point in the sector. When a Namibian company wins a contract to provide a service to the oil sector, it may need working capital, It may need receivable discounting or foreign exchange services. This is not speculative oil finance. This is really contract-backed banking. And it's not that much risky. The second layer could be industry cluster finance. A major upstream sector does not live only offshore. That sector needs housing, it needs training centers, it needs workshops, it needs shore bases, logistics system, and all the other supporting infrastructure. And these are assets local banks and institutional investors can understand because they have physical form, they have broader economic use, and also can support other sectors. The third layer could be participation in larger syndicated finance. Namibian banks do not need to lead multi-billion-dollar upstream financing, but they should not be absent either. They can participate in smaller, well-structured structures alongside international banks. And that is how knowledge is transferred. That is how confidence is built. And that is how local financial institutions move from the margin to the table. Now, a related issue is central to our national purpose. And this is that Namibia's current economic ownership structures were shaped by history. The majority of our people were deliberately excluded from meaningful participation in the commanding sectors of the economy. And if the oil and gas sector develops without deliberate financial inclusion, it may simply reproduce old patterns of ownership under a new sector name. This is why credible companies owned by previously excluded Namibians must be included in the oil and gas finance agenda. And this is not a call for reckless lending or a political favor. It is a call for structured, risk-managed inclusion. And where such companies have credible contracts, competent management, and a clear path to delivery, lack of collateral should not become a permanent barrier. And that is how empowerment becomes measurable, bankable, and real. Policymakers also have a duty because financial institutions cannot lend or invest into fog. They need a petroleum policy framework that is clear. They need a predictable system, a stable and predictable system. They need local content rules that are ambitious, but also practical. They need clarity on taxation, environmental obligation, procurement expectation, and dispute resolutions. Now, a bankable policy framework does not mean a weak national interest framework. It only means that the national interest is defined clearly enough that investors, banks, and citizens can understand it. Because unclear rules do not empower the nation, they empower discretion. Unrealistic rules do not build local content, they only produce fronting. Now, for banking executives, their duty is also clear. And that is that do not wait for first oil before learning the industry. By the time first oil arrives, many relationships will already have been formed. Procurement systems will be in place. International banks will already be embedded in the system. Local banks that wait for perfect certainty may find that the market has moved without them. And I can guarantee you the market is going to move without you if you are not prepared. The Bank of Namibia has also an important role to play, not to instruct banks to lend irresponsibly, Governor Wanguta, and not to direct credit in a way that will weaken market discipline either, but to convene, guide, and clarify. For example, the bank can help the sector think through issues like prudential expectation, concentration risk, foreign currency exposure, governance, and systemic implication. The bank can also identify where regulatory clarity or risk-sharing mechanism may unlock responsible local financing. In this role, the bank becomes a catalyst for our preparedness. Now, local firms too must be honest with themselves, because the call for local participation in itself is not enough. Companies must become finance ready. They must have proper accounts, governance structures, safety systems, credible management, and the ability to deliver under demanding contracts conditions. Because oil and gas procurement is unforgiving, the industry will not lower global standards simply because a company is local. So, ladies and gentlemen, at a moment like this, countries reveal their characters. Some countries discover natural resources and become divided by the resources they have discovered. Some become careless because of those resources. Some become dependent on them, and even some allow them to weaken institutions, and also some allow a few people to benefit while many remain only as spectators. But other countries make a different choice. They use their natural resources to build capacity. They strengthen institutions. They invest in their people. They deepen local financial markets. They create industry around their resource, not only revenue from that resource. Therefore, they turn a temporary commodity opportunity into lasting national capability. And I believe, as Namibia, that must be our choice too. So this morning, I ask every institution represented here to move from observation to preparation. To the banks, this is not the time for fear, it is rather the time for disciplined learning. To policymakers, this is not the time for catchphrases, it is a time for clear, bankable rules. And to the regulators, this is not also the time for rigidity. It is the time for intelligent supervision. To industries, this is not the time to treat local participation as a compliance burden only. It is the time to build genuine Namibian capability. To local businesses, this is not a time for entitlement. It is the time to become competitive, transparent, and reliable. I would like to close with a call to action. And that is to say that the seminar should move Namibia from discussion to structured preparation. I really believe that we need a coordinated national effort that maybe the Bank of Namibia can lead, and that national effort brings together all the important stakeholders. And the immediate task for that is to identify where Namibia's financial sector can participate responsibly in the oil and gas value chain, what risk must be managed, what policy and regulatory clarity is required, and also how credible Namibian firms can make finance ready. Above all, I want to believe that this seminar should not end as a conversation only. It should also produce a roadmap, perhaps assign responsibility, and also maybe have a regular progress review to assess what has been financed, what constraints remain, and who is accountable from removing those constraints. So, ladies and gentlemen, we have been given a rare opportunity. But as I said, opportunity is not destiny, it is an invitation. It is only an invitation to prepare and cooperate, to build our national capability and to ensure that when the story of Namibia's oil and gas story is told, it is not only a story of what was found beneath our sea, but of what was built on the land. So let's make sure that future generations can say, when the moment came, Namibia did not merely celebrate discovery. We prepared, we participated, we governed wisely, we built, and we turned promise into a shared prosperity. Once again, I want to thank the Bank of Namibia for inviting me, and I thank you and wish you fruitful deliberation during the seminar. Thank you very much.
Honorable Alwendo, and I'm going to repeat just to make sure you hear me correctly. You are still honorable. Thank you for that insightful and really thought-provoking address. I think you have provided us with valuable perspectives on the opportunity before Namibia, while also reminding us that institutional discipline, trust, and a coordinated national effort and long-term thinking that is required to translate this resources development that we have into lasting national capabilities. It is our responsibility as a nation to ensure that there is local participation. Therefore, we need coordinated co-creation between government, the Bank of Namibia, financial institutions, and industry to be a key formula. I would like to quote you, Honorable. A nation should not be a mere spectator, but it should also participate prudently. Thank you for that. Ladies and gentlemen, I think Namibia can draw valuable lessons from other African countries in preparing their financial systems for the participation in this oil and gas industry. Uganda's experience is particularly relevant because it highlights the regulatory, supervisory, and institutional questions that require early attention. We therefore are privileged to have with us Mr. David Kalyango, Executive Director of Supervision and Regulation Directorate at the Bank of Uganda. Mr. Kalyango is responsible for overseeing regulated financial institutions and promoting a safe and sound, stable financial sector. With over 30 years of experience at the Central Bank, he has held several senior leadership positions, including Chief Internal Auditor and Executive Director of Finance. Since joining the Bank of Uganda in 1992 as a bank examiner, Mr. Kalyango has played a key role in strengthening Uganda's financial, regulatory, and supervisory framework, including the development of the regulatory framework for microfinance deposit-taking institution. He has also served as an executive director of Pride Microfinance Limited on secondment from the Central Bank. Mr. Kalyango will share Uganda's regulatory and supervisory experience and the lessons arising from positioning its banking sector to participate prudently and sustainably in the oil and gas value chain. Mr. Kalyango, you are most welcome to the land of the brave. The floor is yours.
Good morning, ladies and gentlemen. Before I begin my presentation, allow me to thank the Governor of Bank of Namibia and the Governor, Bank of Uganda, for allowing me to come and attend this workshop physically. I'd been scheduled to do this online, and because of their wisdom, they deemed it fit that they invite me to come and share with you physically, so I don't take that for granted. I also want to thank, there are some wonderful ladies, Litembu Ruwana and the Honorable Kavena, who helped me organize my travel arrangements. I must say I'm very excited to be here once again, to meet you and talk about our experience as a nation. The outline as displayed is simply talking about our experience under those 10 aspects. Because of time, I'll just briefly tell you that we are looking at what oil means to us as a country and what it should do to you as Namibia, what are the concerns from a regulatory perspective, and how do we intend to move forward. But listening carefully to the former governor, once a governor, always a governor, I was encouraged by his speech because most of the issues he has touched is what I want to show you how Uganda has been able to go through. Our story of oil began way back in 1920 when one of the geologists called Wayland discovered hydrocarbons. People saw some white stuff coming out of the ground and they invited this young man, the geologist, to come and see what was coming out. And then he confirmed that those were hydrocarbons, and that was 1920. But we have also since seen the evolution of our banking system, trying to become more and more advanced and now matured based on the range of products that are being offered. And so I thought I should combine these two together, but let me start with the timelines. From 1920, you can clearly see where our journey started. From the discovery, geological surveys started in 1980s and the 90s, so we had those surveys. Coming to 2026, 206, you see discovery. In 2013, they start the framework. And if you can see, 2015, they are establishing an oil company, and in 2022, the final investment decision. And at 2026, we are thinking of the first drop of oil. So our first oil is 2026. In fact, I don't know whether by the time I go home, they would have started. But this date has kept shifting. I would want to share with you why I decided to bring this timeline, to just share with you how much time is needed and why it has taken us this long. It has taken us this long because of a need to agree on how to go about the whole issue of oil. It was so contentious, members of parliament had to engage in intensive discussions of what was supposed to happen. Who was supposed to take what? Who would do what? How were the roles and responsibilities going to be shared? How are the agreements signed? There was a lot of suspicion between the government, members of parliament, so much that at some point they felt that maybe we needed to cancel the whole oil business. But discussion had to go on until they reached agreement. Most of the documentation had to be shared with all the people. And what I'm trying to illustrate is that you need to be as transparent as you can in order to move this industry forward. You need all key stakeholders, the communities that have this oil, the people who are going to purchase the oil companies, the banks that are going to fund, all key stakeholders their roles must be recognized, and you need each other in this whole question of oil. You have no experts, solar experts that will manage this oil for you. So the time from 1920, it is now over 60 years looking at this whole question. Why take all this long? Because of those events that I've described and how they are shaping the oil until today when we are agreeing. And even you can see today, it hasn't yet come out because of some other preparatory work that needs to be done. How is our oil endowment? we are talking about 6.5 billion barrels and 500 cubic meters, 5 billion cubic meters of gas and recoverable crude oil of around 1.5 billion barrels. There was a lot of discussion as to whether these are the exact measurements, because the experts, they say this oil is on the ground. How can we be sure that this is indeed the one? What if it is true, it is over this? What if you have more barrels of oil and you are telling us this is what we have measured? Because they were setting some of these wells to some extent. So there has been this discussion and suspicion of what is it exactly that we are looking at. But for official position is that our endowment is talking about 6.5 billion barrels of oil, 500 billion cubic meters of gas, and recoverable crude oil of that magnitude. The energy infrastructure that has so far been set, as you can see, we have the Tilenga project. The names are given based on the area. Tilenga project is about 70.5% complete and comprises of 236 wells. And on your, I think, left, you will see a map there, and that enclave is where the oil is based. And so we have 236 wells. Then we have Kingfisher. Kingfisher is 78% complete, 22 wells drilled. ECOP is a line. We don't intend to transport our crude oil using trucks. They've come up with an ECOP, a pipeline. This pipeline, talking of syndication, the Honorable Governor talked of the syndication arrangement. Indeed, this pipeline has benefited out of syndicate arrangements. You have Afrexim Bank, Standard Bank, Kenya Commercial Bank, KCB. All these have contributed to this pipeline. So it is one of those infrastructures where oil will be pumped from these wells up to Tanzania, and it's more or less complete, as you can see. Then we have the Uganda refinery. The president of our country would like us to sell a final product, and so he's very keen on having this refinery, and the development is expected to start next year as part of the developments that he would want to see, sustainable developments. He finds it shameful for us to produce oil and still import oil, yet we can refine our own oil from the wells to the refinery and to the final user. Then the rest can be exported. So the target I've already mentioned is this quarter, last quarter of this year, 2026, we expect some oil there. For oil to proceed well, for you to take advantage of these benefits, you need to have a proper institutional framework. And this is what has taken a lot of time negotiating. We have a clear separation of institutional roles, which gives financials certainty. The financials are certain about who is doing what. And some of the roles include policy leadership and overall direction for petroleum sector, and that is under Ministry of Energy and Mineral Development. You then have the Petroleum Authority of Uganda. This is in charge of licensing, regulation, and monitoring of upstream and midstream operations. Then you have the National Oil Company. This deals with commercial participation across petroleum value chain. You have the Uganda Revenue Authority. Whenever there is the revenues coming in, the taxman has to be very close to the area. And Uganda Revenue Authority is in charge of tax administration and revenue collection. Why this is so? During the stage of development, there are a number of sales transactions were going on. And as I speak now, we have so far enjoyed $490 million of capital taxes gains out of this transaction. So URA, which is in short Uganda Revenue Authority, is the tax administrator. Then you have Ministry of Finance, the in charge of fiscal policy and stewardship of petroleum revenues. Now, the Bank of Uganda, which I work for, the central bank, is in charge of financial system stability through prudential regulation and supervision. And its other role is to oversee the management of the Petroleum Revenue Investment Fund. We've been given that responsibility that when oil revenues come in, they go to the Petroleum Fund. Then money is appropriated out of that fund to the central bank for investment as a sovereign fund, and then part of it, of the other aspect of the revenue, goes to finance the fiscal operations of government. So as a central bank, our role will be to oversee that ring-fenced fund of the Petroleum Investment Fund. Now, this took time to come to stream as you see it. A lot of time was put into agreeing this. Members of Parliament, wherever you are, you have a key role to play in making sure that you create sanity, because the government interests may be different from those of the oil companies. The communities need protection on how the revenues are going to be deployed. Agreements need to be negotiated. How much do you sell? What are the revenue sharing agreements? Because government was not putting in the money. It invited these oil companies. Now, how do you give back? Now, there is time needed to review these agreements to see whether the revenue sharing agreements are indeed favorable to the country or they favor whoever is investing. It is in the best interest of every citizen to know what they are. And at some point, there was even discussion and consideration was made to have them translated in local languages for everybody to understand what it meant. Because the communities thought that this is a resource that was belonging to somebody else. And yet is for future generations. Our enjoyment today shouldn't deprive our future generation of enjoying the same resource. So a lot of time has gone into ensuring that these roles are clearly understood, the agreements are known by everybody, the agreements are transparent. And on this note, I would like to thank our members of Parliament. They indeed had to have a very big role to play in making sure that all these agreements are shared and are presented and are known and they are transparent to allow for proper decision making. So this is some aspect that I thought we should look at as clear mandates to underpin bankability, because stability starts here. If this is wrong from the start, even when oil comes from the ground, it will just pour away. You'll find wars, sabotage. As trucks go, they are bombed because there has not been proper understanding of each other's roles and responsibilities. This is an important point that has taken time to consider, and this may have also contributed to the times of agreeing even when the first investment decision was to be made. The other aspect in setting the context is that why now? Now, Uganda's oil sector is advancing from development toward first oil, drawing banks into this new financing. It is now important than ever before that banks start considering oil financing. And the regulatory guidance now is better suited before big exposures increase. Our consideration that before we have all this expansion, you need to make sure that banks are now well positioned to understand the business. Like the Honorable Minister said, that the time to prepare is now, not when the first oil comes, but now as you develop, as you consider development, so that you prepare well enough. There's a Chinese proverb that says armies prepare for war during time of peace. You don't prepare for war during time of war. So when you see armies during time of peace, they get involved in a lot of training. They learn more tricks during time of peace. So this is the time is now. And also one other principle, they have mentioned the importance of this oil. One other principle is that the prudential participation should not in any way be compromised. We should maintain, much as we advocate for that participation, we should not compromise safety and stability of the financial system. Why does oil and gas matter to us? We believe that large petroleum investments affect liquidity, foreign exchange, inflation, imports, and all that balance of payment. They have said it all. And banks gain opportunities in making payments, deposits, trade finance, guarantees, foreign exchange, and so forth. So, but when that is done, we're also anticipating that there are going to be a number of risks that the sector needs to properly understand. And one of those will be credit concentration. How does the banking system deal with the whole question of credit concentration? This is a real threat. Credit concentration is putting too much resource in one sector. Or it is like you are putting all your baskets relatively in one basket. So in addition to that, we have volatility of funding, foreign currency mismatches. And there's also another vice. Most of our countries have been on the gray list. They are moved off the gray list. So the anti-money laundering regulations are part of that aspect that must be observed in handling all these transactions of oil. Money laundering wants where there are big and quick monies. And this is one of the sectors that has attracted that vice. So we are mindful of that, and in our country, we have a framework that is intended to deal with that. Because we are now off a grey list, we are required to follow all of the FATF recommendations that took us off the grey list. What is our supervisory question? Is that how can banks support oil and gas development without weakening individual institutions or undermining financial stability? What are those considerations? In answering that question, one of the keynote speaker even alluded to it, that banks should not be forced to go there, but they should be instead enabled. They should be led to assess the risk of participation at their own peril, rather than being told, we have oil, we must all go there. So as part of the consideration, this should be a voluntary exercise. They should not be compelled. They should be encouraged or enabled or facilitated to go there by that institutional arrangements which I've talked about, by a good regulatory environment from all the respective parties. National importance should not justify regulatory forbearance. The Honorable Governor mentioned something about the national content element, because according to our process, the law requires that a certain portion of businesses relating to oil must be done by the local people. Certain jobs must not go to outsiders. They must be done internally. Now, these people require financing. That does not become automatic. Banks should be led to do a proper appraisal of all these processes. You should only lend when you are satisfied that this national content provider can indeed qualifies. They have mentioned issues of collateral. So the participation, therefore, from a supervisory concern should be driven by capital. How much capital do you have? Do you have adequate liquidity? Are there adequate governance structures? And do you have a robust risk management system that will help you assess these risks? Governance for us has been critical. What are we looking at practically? We are saying that if you are to go into this business of gas, do you have an understanding of all the value chain of this cycle? Do the board members fully understand the business flow involved in gas? What are the discussions at that level of the board? Have they relegated their responsibilities to experts? Do they understand the risks they are taking? So that aspect is what we are looking out for as examiners or supervisors in answering that supervisory question. Now, in answering that, these are the value chains, in our view, we think, that all financial institutions that intend to look at this issue of financing oil and gas must understand. We have the upstream. I know you have experts here that know it better, but we must understand. If you don't understand, we must here be compelled to understand what upstream activities are, what downstream activities are, what midstream activities are, because we must be able to give finance to each of these, and we must know the interconnectedness. And how do I identify which opportunities are available in each of those streams? So in looking at it, we are saying that the banks that are appearing into this sector, if you intend to finance, you need to demonstrate evidence that you competently understand the value chain. If you don't understand the value chain, you have no business going into it. you only risk losing the depositors' funds, because we know that the depositors are largely the ones that are funding you. So this value chain is critical, even at the central bank. Imagine I'm an examiner, and where I sit, I must learn what upstream is. If I don't know, I must be compelled what downstream is as an examiner and what midstream is, because that's where the banks are expected to play. And if they play there, how do we provide adequate oversight to see that they have indeed satisfied the requirements and they are able to tell the risks associated with each of these chains? Where can banks participate? There are quite a number of financial products, as you can see: cash management, BD bonds, working capital, syndicated arrangements, equipment financing. I've mentioned each of these. But key to this, there's going to be a lot of off-balance sheet activity as a large proportion of this entire process. Are banks well positioned to understand this? This is where we have been at that competence, the education. Many of them have started that preparation to try and understand how to structure these funding arrangements in order to take advantage of the opportunities that this oil and gas sector has provided. Any bank that intends to go there has to demonstrate to us that they fully understand the kind of arrangements that are available in the oil and gas and how these can be structured using their internal processes. And as I mentioned earlier, that they are not going to be compelled, they are going to be enabled or they are encouraged to participate. But they must demonstrate that they have a robust risk management system that is able to help them understand this and also mitigate any risks that may come up. Our sector, as at 31st December 2025, is approximately $17.8 billion in net assets, and we remain largely capitalized. But there has been an effort in trying to look at single borrower limits, understanding large exposures, understanding liquidity arrangements, as I said, the constraints and in terms of what expertise is needed. And so from that level, we are able to measure who can participate in what and in what area based on the capitalization of the banking system. We do not have separate preferential prudential regime for oil and gas. We think that the risk management system of banks, especially as they follow risk-based supervision, they are able to fully understand the capital allocation, because risk-based is about applying your resources to areas of significant risk. So it is expected that as new businesses come up, these banks should be able to understand the nature of business they are going into. So we want them to use the existing framework. We have national content and development objectives that should not override classification, provisioning, capital, liquidity, or concentration standards. We don't have a process whereby if a loan is lent to a gas sector, its provisioning requirements are going to be different. Loss is loss, and the money smells the same. A loss of 1 million, whether in gas or in another sector, is the same loss. But what is clear is that we must be able, does the institution demonstrate understanding of the risk they are taking? Can their balance sheet accommodate it? Have they planned for liquidity? Because money smells the same way. The intrinsic value of money is the same. Whether you hold a note of 100,000, once it is lost, you lose the same value. So that aspect for us has been key in overriding our understanding of the aspects that banks are going to be dealing with. So we expect them to do proper provisioning following the current rules. This is not to say that we've not had regulatory reforms. We've identified some areas. I want to sing out one. Like when you get to single obligor limit, the current ratio has always been tagged on the core capital. It is 25% of core capital. Now, based on the reforms we've seen, that could be a constraint in terms of how many singles you are able to give. We've gone around that by saying that we need to reform the base, the core capital, to instead consider it as 25% of capital, total capital of a bank. We look at the total capital you have rather than looking at only the aspect of core, which is, those in supervisor language, I think know what I'm talking about, that core capital is just that aspect of tier 1. We are now saying get your tier 1 and tier 2, 25% of that. We hope this will give them room to do more and more lending. And we think that your balance sheet strength should drive what kind of risks you take. If you want to lend more, bring more capital, because capital is supposed to cushion you against loss. There are other reforms which we touch on, like, guarantees in our regulatory framework have not been attracting capital relief. If I have a loan that is fully guaranteed, 100%, when I'm asking for risk capital, it has always been 25% of the, 12% according to Basel. But we are now saying the reforms that we are contemplating, that if you have a guaranteed loan, the guarantor is rated, that should be able to give you relief on how much capital you need to earmark for that specific lending. So that reform will help us to release capital resources so that you can expand your business. Previously, they would not benefit out of guarantees, and there has been intensive discussions with the Bankers Association to compel us to really rethink that aspect, because if a guarantee is from some rated entity, AAA, say World Bank giving you a guarantee that have guaranteed that, why should you want 100% risk capital? So we are saying that if you have a rated entity with a guarantee given, that should attract relief for you. Instead of having the whole 12%, it should be reduced so that you don't require 12% of risk capital. Because the minimum they are required for each loan should be a minimum of 12.5%. So you don't need that full range of 12%, but you factor in that aspect of core capital, of the guarantee. The other aspect we are looking at as a supervisor and what the banking sector to understand is the full exposure. You remember that you have direct exposure. The direct exposure is usually on the balance sheet, but there are quite a number of instruments that do not appear and yet they are critical, like the bid bonds, performance guarantees. We want them in their review of risk related to this lending or financing to demonstrate full understanding of the full exposure to the entire stream value chain. Somebody who has a guarantee for transportation, for instance, you have a bid bond and you may have direct borrowing, don't only consider the direct borrowing as exposure. Measure also to the extent of the off-balance sheet items that have been provided in terms of supporting the lending to that sector. So full exposure here is important, and we must show that they fully understand and is factored into the operations, and our examiners too are obligated to make sure that they also understand what is going on, because this has capital implications on capital. If you see the kind of values we are talking about in the bid bonds, if these crystallized, you have a huge capital outflow, and if you didn't provide for it, you have a challenge. And so part of these indirect exposures are also going into being risk-weighted as part of the reforms that we are anticipating in order to effectively utilize the benefits accruing out of the oil and gas sector. These are the prudential risks that we are contemplating. They are known to all of us, and oil is just going to amplify them. We've always had these risks, but when oil comes in, there are those that are pronounced. Project risk is one of them. You drill, finance somebody, he hits no oil. What do? You've lent, and given the amount of money, one person can easily weigh you down in its portfolio. So concentration risk is one of those that we are looking at. Concentration risk is very unfortunate that if you are not careful, one loan or concentration of your lending in a few borrowers can bring you down. I'm sure all the examiners know this. Then there is off-balance sheet risk. These aspects I've explained, I wouldn't like to repeat. And then the volatility in terms of liquidity of deposits is one of those that also we are looking at as considerable risk to the sector, that banks should show us the mitigants against these risks. These two, we are talking about integrity, operation and sustainability of risk. Sustainability is one of those aspects. We are saying that our enjoyment today should not deprive the future. So we have got to be very careful of how we handle the resources we have today in order to not to disadvantage our grandchildren. Because once oil is taken out, it has gone. What do you do with the money? So these aspects of transactions, we need to be more transparent. We need to see that we observe the environmental safeguards are in place to ensure that. One of the issues that we are looking at in our banking sector, ESG is one of those considerations that now are taken as part of a supervisory review process. The Bankers Association in Uganda approved an ESG framework. They agreed on those 3 pillars. They agreed milestones to comply with them. And so each time I go to review a banker's operations, they must demonstrate to me how far they have gone in implementing the ESG in their operations. Many of them, they sometimes don't tell the truth. They will talk of sustainable green loans, and when you ask them, where are these sustainable finance loans? So we are likely to see a lot of environmental concerns in this oil and gas because of whatever is involved. And so climate risk is also another aspect that is of consideration. We believe will drive sustainability because it is now a standard. Sustainability is no more discussion. We are saying our enjoyment today should not deprive the future generation from enjoying the same resource. So where we are deploying resources should be able to guarantee us that aspect of sustainability. There is discussion of oil is always not complete without looking at the Dutch disease. Our president has taken the view that although they refer to it as a curse, for him he does not believe it is a curse, it is a resource, but the problem has been how we manage economic benefits arising out of a resource boom. And so he has been key on telling us, on making sure that all resources are put in place to show us how we intend to go over that problem. One of them, there are several of them, like you saw the Sovereign Wealth Fund. One of the key safeguards they put in place is the creation of the Sovereign Wealth Funds. That helps us to keep the reserve away. You get out of, don't eat everything. Keep something for tomorrow or for the future generations. Also, in my country, the government has prioritized sectors. There are about 5 sectors that have been prioritized: agro-industrialization, tourism, mineral and gas, and then science and innovation. Now, the objective is to make this, to grow them by 10-fold by the year 2050. We expect to have grown the GDP by 20%. Now, when you look at the strategy being adopted, it is intended to primarily deal with the aspect of growth that we anticipate to get from oil, so that we avoid the effects of the Dutch disease that we are talking about. Consideration has also been given to the central bank to look at ensuring macroeconomic stability. In our planning and forecasts we track the element of oil on a daily basis. We are tracking development, liquidity requirements, whatever happens. So as such and such investment came in, it will be tracked in order to see how to adequately respond to those numbers. So preparation is preparation. If you need to manage this aspect of growth, to manage the benefits arising out of oil, we must adequately prepare for them now to put in place a mechanism. They say when oil comes in, some sectors decline in competitiveness. People tend to abandon. But that strategy is ensuring that the competitiveness has been guaranteed or will be guaranteed even when the oil starts flowing. You maintain macroeconomic stability and also make sure that we have other sectors that are made prominent. They can help you guard against some of those. So those are some of the mitigants: exchange rate stability, monetary policy safeguards, prudential. They are largely what the central bank should ordinarily do. But this time, from what I've seen in practice, any development we track. There is a word that burst we track. What does that have? What implication does that have on our liquidity, on the exchange rate, on GDP, on inflation? So these are tracked in line with that. The rules require that we provide an allowance for local participation. I've already talked about this, but these players have limitation in terms of collateral, in terms of bankability. We are not compelled to just give them money or allow banks. We are saying do the analysis, as the Honorable Governor mentioned. Adequate appraisal need to be done. You need to certify yourself that indeed these are bankable. If they are not bankable, find alternative ways of making them achieve that. But the issue here is that do not give out all the jobs. This oil has a tendency to almost outsource everything. Everything. They are preserving this in order to ensure sustainability, in order to make sure that local communities retain also some benefits out of this process. In Uganda, welding jobs, say digging these pit latrines, constructions, they are basing on, they have earmarked those for the local guys. If you if you don't have proper regulations or frameworks, you'll find out that all the oil companies can outsource everything, even drivers, even forklifters. All these can be outsourced. So the local content, there are certain products that need to be outsourced locally, and this is something that which has been provided for, but we are saying do so prudently. Do so prudently. Don't just give them out of mercy. Do proper appraisal as a bank. We won't see, you cannot come to us that, the loss we are making is because we gave to a prioritized sector for local content. If they need education, give them education. If they need, but giving them finance because you are lending depositors funds, it is important on you to make sure that you disburse funds to bankable projects. Our supervisory kit has those elements, standard definitions of exposure, the examine governance, credit appraisal, legal review, controls, classification. So wherever examiners are, these are aspects that we are looking at. They do stress tests. Each bank is supposed to conduct a stress test to confirm that if oil prices declined, what impact do I have for the people I've lent? How will it impact my balance sheet following developments in the sector? If prices of say transportation increase, how does that impact me? What is that impact? How does it play out on my capital? Will my balance sheet remain intact? So stress test is also one of those that supervisors are expected to have in their toolkit to see that banks do it. If a bank has done it, even us at our level and our financial stability department, they conduct quite a lot of that to stress the system and see in case of oil dropping to say beyond 10%, how does that play out on the financials of the bank? But operation depends on how complex the instruments are and how prepared the bank is. I want to skip that. Why would it matter to Namibia? It would matter because of the benefits already illustrated. I wouldn't want to repeat this, but I want to go to some of the lessons that we can take on board. I don't know whether Namibia has already gone through the regulatory, the institutional framework arrangements, but in case you haven't, this is a point from which to start as a sector, as a country, to make sure that we have a proper institutional framework relating to governance of oil. It should be participatory, covering all sectors of the economy. Initially in Uganda, when we started, it was something of the elite. The groups in the ministries would sit. They didn't involve local communities. Time came when pressure mounted and saying, can't we learn lessons from other countries like Nigeria all these other countries have taught us that conflict can arise because of failure to communicate proper agreements, because of non-disclosures, because of poor governance structures. So that aspect has taken a bit of time. But we want to see a preparation from the examiners. Our examiners have been prepared to try and understand what risks there are that banks are likely to face if they engage in oil. So are you prepared as the central bank? Is your research department also prepared? Financial stability, the supervisors, when they go, are they communicating the language of oil? Because we must orientate them towards that. Do they map the full value chain, the downstream, the midstream, and then the upstream? Do they understand that exposure? Is there a full understanding of that exposure? What are funded? What are the foreign exchange issues? All these disposals, all these exposures. Because as you fund somebody, you book an exchange today. By the time money gets to come, the rates might have shifted. What arrangements are in place in these banks to accommodate complex foreign exchange transactions? Hedging instruments are going to be handy because they are dealing a lot in terms of these components, and they require complex financial products in order to ensure that the risks are properly mitigated. National importance should not be equated to low risk. There are these sectors we've talked about, the local content, they are deserving. Yes, they are deserving, but that doesn't mean that these are low risk. Just give them money because you are supporting oil and gas. They need to be facilitated in a smart manner. We must make sure that if they need something before finance, let that be done through financial inclusion arrangements, as my honorable governor mentioned. Financial inclusion gives them some education on how to govern themselves, how to manage aspects of finance. Match the banker's participation to institutional capacity. Capital is everything, but also governance arrangements in place. If you find an institution whose board does not understand the gas transactions and they are funding gas, then you know you are headed for trouble. That could be candidate for closure, candidate for intervention, because the amounts involved, one loan could easily impair them. So in order to preserve the capital from impairment, they need to be saved that burden. But how can they do it? They are encouraged to prepare and prepare and prepare. So they are supposed to do two things: prepare and prepare and prepare. Interagency coordination is one thing that we have seen. Interagency coordination is one of those that is important element. Much as we're a central bank, we are supposed to engage with Ministry of Trade, Ministry of Finance, Petroleum Authority, oil companies. Right now, each time there are transactions, our research department must understand or ask them, how much oil are you expecting? How much are you paying for? So that coordination has helped us understand the risks associated. They are not going to be surprises. If there's proper coordination, rest assured that you reap the benefits out of that oil. So build specialist capacity, that is one of them. Encourage syndication. Sell downs are quite common, guarantees. I've told you the ECOP line. No single bank could have adequate capitalization to set it up. Syndication is a norm. And what we do at our supervision, all these bring their applications for no objection. Like I remember the ECOP, since I'm talking to fellow examiners, this is confidential information. We are discussing our own things. I hope no one will quote me, because I'm not supposed to mention a bank without their permission. But as examiners, we are allowed to discuss amongst ourselves, because what is a risk to me under cross-border arrangements, you can easily become a source of risk for me if I don't tell you what to watch out for. But syndication is one source of funding that we've seen because of the value of the transaction. Some of them cannot adequately go it alone. So they use their levels and pair up with partners that can help them deliver product. So the ECOP line that you are seeing is a syndication of Afrexim Bank, Standard Bank, KCB, and others. Don't say I told you, but these are banks that have syndicated. So guarantees are there, but as I mentioned, we must know, we must not look at we should no longer look at them as just off balance sheet activities. When you are carrying out analysis, we tend to bring them as though they are balance sheet items, because as we are assessing the risk, that could be a potential source of risk, although they are off balance sheet. Concentration is one of those that we are thinking of as a key risk that is going to be something that you need to take care of. Because of the values, oil has big values. You find that in all your portfolio, one loan could be tilt you towards, bankruptcy in case of problems. And the others are much more of issues of planning. So planning is something that we need to engage, and supervision, as I've mentioned, should be forward-looking. We've continued to integrate ESG. ESG had been something that was something of NGOs, but it has been mainstreamed. If you count my central bank, any bank that comes before me, we must have a conversation about how far you have gone on ESG implementation. Is it properly understood? Are there governance structures that discuss it? And then the stress test aspects of it, which I've mentioned. This one I already mentioned, that we've had capital adequacy reforms. Going forward, we want this to unlock capital. You talked of lending to single borrowers. Now, when that ratio is not properly managed, you'll find that you are going to restrain banks from lending enough because of this limit. So in order to do that, we are saying that credit risk mitigation, you need to, like, if you have credit insurance and properly rated, it is one of those that you can look at to unlock capital. I was discussing with my colleagues in the yesterday, and some of the regulation will differ as the countries, but there's an harmonization project. In where I come from in East Africa, we have a monetary affairs committee of the governors of central banks of the East African community. We always meet, and this is one of the areas that we are pushing for harmonization, that if I have a guarantee from a reputable rated company or corporate, that guarantee should earn me risk capital. I should unlock the capital requirements. Instead of giving 2 loans, I should be able to give 4 if they are rated. The dynamics can be agreed, but the principle has been widely accepted. So there are going to be some reforms in some of the rules. My governors put it that you can no longer afford to sit down without considering reforms. There are going to be necessary reforms, but without compromising safety and soundness of the financial system, as well as financial stability. We should not just do it out of mercy, but it must be based on reason. The closing message is that oil and gas can deepen the financial sector and support economic transformation. Benefits depend on disciplined underwriting, sound governance, transparent risk sharing, and strong supervision. The prudential objective is not to prevent banks from participating, but to ensure that participation is safe, proportionate, and sustainable. We want you not to live only for today, but your livelihood should help the future generations. With that in mind, I want to thank you very much for your attention. I hope this can be a useful point to also consider, but our story has not been that easy. There were protracted arguments, suspicion, but all that, as I speak now, we appear all to be aligned, expecting that first oil. Pray for us. I'll send you an email when that first drop comes out of the ground. With that, thank you so much for your attention. May God bless you.
Mr. Kalyango, thank you for sharing Uganda's practical experience and lessons with us. Your presentation has underscored that supervisory preparation must begin before exposure become material, and that participation in the oil and gas should be enabled with should be enabled without compromising prudential standards or financial stability. You have also reminded us that there is importance in mapping and understanding the full value chain, matching each bank's participation to its institutional capacity by preparing and strengthening specialist skills and inter-agency coordination. Additionally, you have said that using transparent risk-sharing arrangement to support local participation is paramount. Importantly, preparedness must extend beyond the commencement of production through forward-looking supervision and stress testing. Additionally, you have said that concentrated funding, Dutch disease, and the eventual post-oil transition should be taken into consideration. Ladies and gentlemen, I think you would agree with me of how rich and informative this presentation was. It is therefore that just fitting for us to just tweak or modify the program just a little bit to just allow 5 minutes for 2 to 3 questions from the floor. If you have a question, please just raise your hand. There are mics that we can bring to you. Please introduce yourself and the institution that you represent. There's a hand in the front. Mr. Asap.
Thank you very much, Jason. Thank you very much, Mr. Kalyango, for a very insightful presentation. My question, I'm from the AML space at this point in time of my life. From the AML, head of the FIU. I wanted to understand whether you have done a comprehensive risk assessment in as far as the money laundering, terrorism financing, and proliferation financing risk is concerned. And the reason why I'm asking that question is you've touched on a very important aspect. I know that, yes, as much as the promises that this discoveries hold, it also holds exceptional risks. We've seen it in Mozambique, for example, up to the point when they have discovered gas. Now we have a terrorism situation in Cabo Delgado province. And I wanted to understand, how should a country go about in ensuring a comprehensive AML, CFT, CPF risk assessment? Thank you.
Should we give the question or for him to respond?
I think let's take 2.
Oh, can give it to August first.
Thank you so much, Kenneth from Namfisa. And thank you for the insightful presentation and the experience from the Ugandan perspective. My question is, I know from Uganda, there are different regulators there, the insurance regulator, capital markets regulator, and so forth. How do the experience looks like in terms of how the regulators coordinate and cooperate? Because there are some contractual savings that are around in the country which are being regulated by different regulators to ensure that there is success in terms of what the country wants to move forward. Whether there are some institutional arrangements that are in place so that we can learn from that.
Thank you very much. The first question is on AML, that how are we doing a comprehensive risk assessment? Have we done one FATF recommendation require that a country does a comprehensive risk assessment. This is currently ongoing between Bank of Uganda and the Financial Intelligence Authority. It is one of those key requirements against which we are going to be evaluated. So this is a must do. We are doing it, but except that by the time I came here, the report wasn't yet complete, but it's something that it is a must do, anyone complying with the FATF recommendations. So this is in the process, and I believe once it's finished, it will have to be published in line with the requirements of the FATF recommendation. So this is a given. So the one coordinating it is the Financial Intelligence Authority, and the Bank of Uganda as a regulatory authority is also involved, and also the others, key players, or reporting entities are part of this process. I think that can be enough for now. I can also link you up with my AML team, because as Bank of Uganda as a reporting entity, we have a unit for anti-money laundering issues, and it goes around all commercial banks to ensure that we do proper supervision, or for AML purposes. Each normal examination, there must be some people embedded in that examination team looking at AML aspects. The same can be said about cyber. So there's that arrangement. How do regulators coordinate in Uganda? We have a financial stability forum. Now that's a forum that brings all regulators together to discuss matters, cross-cutting issues related to stability of the financial system. There's Minister of Finance as a key player, Capital Markets Authority, pension regulation, insurance regulator. All these meet on a quarterly basis, and all they are doing is look out issues of common interest and how they go about it. And I want to give a practical example. If, for instance, we are vetting someone by Capital Markets Authority, but that person had already been vetted, or is a director of a bank, but Capital Markets Authority wants information, they don't need to redo the work. They refer the case to Bank of Uganda, where we have information about that subject and give them our assessment. So they rely on that assessment. And of course, this has come with having signed the MOUs, Memorandum of Understanding, that we shall be sharing this. And it's a widely accepted forum. And if you notice, they always have a communique each time we have a quarterly meeting published on the website of the central bank, because the central bank is acting as a secretariat. So there's that structured coordination, and we follow that. And it's one of those things that has helped us ensure proper coordination of the financial stability in the sector. Thank you so much.
Thank you very much. We'll take 2 final questions. Thank you.
Thank you very much. Also from my side for the insightful presentation. Latching on to the last question in terms of financial stability, if you could just share with us the enhancements to your macroprudential toolkit to cater for the oil and gas. Thank you.
Okay. We have one here. Okay.
Good morning, everyone. My name is Vasco Victor. I'm an analyst at Cicedi Investment Group. My question is more around the refinery aspect. I found it very interesting how you've started planning for a refinery before first oil. And in Namibia, I don't really hear sort of much around this. So I want to understand Uganda's thinking in terms of the transmission mechanism, how that sort of enables more industries, because obviously refinery is able to, there's so many byproducts going from bitumen to the plastics and all of that. So how does that sort of enable lower barriers to entry perhaps, and how you see that mechanism in the transmission mechanism here?
One final one from the governor. I'm employed to do that.
Can the speaker repeat the question? The last one.
About the refinery.
Are we waiting for the repeat?
Yes, of the refinery.
On
Yes.
the refinery, yes.
Yeah.
Yeah, so I just wanted to understand the thinking towards why you decided to sort of go the refinery route, and how that transmission mechanism into smaller companies in the industry? Sort of, does that bring a lower barriers to entry for them?
Go ahead, Governor.
So my question, thank you very much, MC. I think my question will just be direct to David. Now, given the lucrativeness of this oil and gas industry, the financial sector can view it also more or less as a risk-free, because I think it's quite lucrative. Now, in light of that, how do we ensure that the other sectors in the economy in terms of lending do not become orphan, are not completely neglected, and all the credit lending, the banking sector is directing more towards this lucrative oil and gas industry. So how should we frame our mind? How should we prepare ourselves towards that possible outcome that may frame itself in that manner? Thank you.
Thank you. I will start with the governor. You know, for us central bankers, governors are the ones that, sign the paycheck. So I don't want to make him last. Okay. This oil and gas is a lucrative sector. Indeed it is. And he has anticipated that it's likely to attract a lot of attention. More money is likely to be driven towards that. Now, as a country, they have prioritized certain sectors that they know could suffer. One of them is the agro-industrialization. Another sector is tourism. Another sector is still mineral and oil and gas. And the other one is science and innovation. In the wisdom of His Excellency, the President of the Republic of Uganda, he chose the mantra that he needed the economy to grow tenfold by the year 2050, that we should have grown our GDP by tenfold. Now, what this does is to allow for economic diversification. If you see, we have competitive advantage in agro-industrialization and tourism. So he thinks that resources are going to be directed to these sectors simultaneously as the oil and gas investments continue. Agro-industrialization is one of those that whose competitiveness should not suffer, because the country is largely based on agriculture. So these are some of the safeguards, and the Minister of Finance is coordinating this initiative. They expect this to be a private sector-led initiative. Now, the banks in Uganda have been asked to come up with a strategy on how they intend to finance this. So each of them is supposed to come up with a plan in line with the strength of their balance sheet. So this is, for me, is a bit of a safeguard that will help us make sure that not all is concentrated on oil and gas, but the productivity here, there is a commitment from government that this is where we are headed. The vision is that let us grow the economy tenfold following this. Now, these private sectors are quite competitive in Uganda, and if we supported them, we would match the revenues from oil. In fact, some of the oil revenues would instead be devoted towards developing this. And then also, when you bring the sovereign fund, if you see how we have structured the investment of the oil proceeds, not all will be spent under fiscal arrangements. There's first of all a proportion of which must be spent for the people, and a proportion that has been ring-fenced, and that one is supposed to be coming to the central bank. Now that will be acting as the sovereign wealth fund. Now this is supposed to absorb the shocks that are likely to come from, again, oil and gas becoming a problem by drawing on this during times of trouble, and we expect to do more savings during times of the boom. So as oil revenues come in, it is expected that more and more savings are going to be done in order to prepare for the time when we have the declines in the growth of the economy. I believe that, for me, is what I can attribute to the safeguard that is being contemplated by the government. This 10-fold growth strategy is one of those economic diversifications to guard against the decline in those competitive sectors, like is usually the case when you have the oil. Now, does the macro-prudential policy framework cater for oil and gas? This is a must. It is catering for it, and already they are working on scenarios, possible scenarios. They are looking at on the first day of oil, what would happen. Then the subsequent. So I want to tell the person who asked the question that this is one of those developments that must not skip anyone in the macroeconomic prudential framework who is doing it, because it is a key event that can impact the economy greatly and also affect stability. How does the refinery make business sense? In the wisdom of His Excellency, our President, he has strongly supported the view that you need to be self-reliant. We don't need to donate money that we are donating. So they think that we are able to exploit, to extract more value out of our oil if we refined it. And I think Nigeria has gone this route. And if you notice recently when they met in Kenya, Dangote offered to help us put up a facility. So this is something that has been properly considered as likely to help us extract the benefit out of the oil that is coming in. And we believe the products, the jobs that are being created, not only the oil will be coming out, but even the jobs which are being created. The refinery is located in Uganda, and those are going to be jobs for Ugandans. He's fond of saying, why do we donate jobs? You take your oil, then again import it. And the people there do your oil. The same has been said of coffee, that we grow coffee, export it, and then import chocolate. And chocolate is even more expensive than the price of coffee. So is that stop donating jobs, do value addition. If you came, the message is the value addition. We want to add the value so that we also start exporting oil. That is the spirit of this. Is it viable? I can't tell now. But what I know is that we must have, this is a tall order, we must have a refinery to add value to our oil so that we get maximum benefit out of it. Thank you very much for your attention.
Mr. Karyango, thank you very much, and thank you very much for the questions. We sincerely appreciate the Bank of Uganda's willingness to really share its experience with Namibia. Ladies and gentlemen, we now are moving on from sort of regulatory and supervisory preparedness to the practical question of how capital can be mobilized and deployed into the oil and gas sector. It's my pleasure to introduce Mr. Roland Brown, Director of Cyrus Capital, who will deliver a presentation titled Innovative and Routine Funding Option for Local Content, with a focus really on structures for intermediating capital into the oil and gas sector. Roland is a Namibian economist with a focus of financial economics. Born and raised in Namibia, he studied in Scotland before returning to Namibia in 2010. He worked in the Namibian government and central bank, as well as commercial banks and non-banking financial institutions. He spent a number of years consulting to the IMF on financial system stability with a focus on East Africa. In 2017, he co-founded a diversified financial service company, Cyrus, with a focus on stock broking, asset management, investment banking, and unlisted investment. The Cyrus team are market leaders in research, financial market development, and channeling investment into innovative end product in Namibia. Roland serves on multiple boards across Namibia and South Africa. Mr. Roland, please, the floor is yours. Thank you.
Thank you very much. Thank you, Jason. Governor Wanguta and the Bank of Namibia team, thank you very much for hosting me today on this important topic. And my regulator in the room, Mr. Matamola, I recognize presence of as well. Please don't take anything I say to be too offensive. I'll do my very best. Honorable Alwendo, or as I still fondly know you, DG, from working together 16 odd years ago. And Mr. Kalyango from Bank of Uganda. I also worked with the Bank of Uganda a lot, also now many years ago, specifically on macroprudential tools and amongst others looking at contagion risk for oil and gas within the East African region as a whole, and a lot of stress testing and similar around that. So when the DG and I, the Honorable Minister subsequently, but when the DG and I worked together, I was of course extremely young and he was very young, but much has changed on both fronts, I suppose. I would like to advance some of the points that have been made already. This is a tricky and an interesting topic, and it's a lot. It's quite different from what I usually talk about. I usually talk about the esoteric things of GDP and things that you can't eat, as many people like to tell me. But today I need to talk about something which is a lot less esoteric, a lot more tangible, and I think probably as a result somewhat more important. But the challenge around this and the challenge around the topic of local content in general is a challenge around the how. If you ask an economist about unemployment and how to fix unemployment, they'll tell you, well, create jobs, which is not very useful. It's similar to if you ask a CA how to improve your profit, they'll tell you, increase revenue and decrease cost. It's also not very useful. But this is the question of how to fund local content is a complicated topic because it's like being asked, how do you climb a mountain? I was going to talk about how you eat an elephant, but I think we all know the answer to that one. So how do you climb a mountain? And without a lot of information in terms of the details of the specific mountain you're trying to climb, it's very difficult to give a one-size-fits-all answer. So you need a lot more information. Is it a steep mountain? Is it a sort of low incline mountain? Is there snow on the top? Is it very technical? Without that sort of information, it's difficult to give a succinct answer. But I'll do my best when it comes to what is ultimately quite a complicated topic. Now, unfortunately, I can't just talk about it in isolation because it is so complicated. So we do need to provide some kind of context when it comes to the mountain that we're looking to climb here. So what I've been asked to talk about specifically is this intermediation channel and how you intermediate capital from those that have capital to those that need capital. And if you go and you look at the origins of Cirrus, the company that we founded, this was one of our key objectives, is finding better ways to intermediate capital from those that have it, that want to return on it, to those that need it, that are able to generate that return. So capital is a big part of this equation. But the other part of the equation, and I think this has been mentioned by a number of, or both speakers that came before, is what that money actually flows into. And we can talk ad nauseum about local content, but unless we actually know what the local content is that we're trying to capture, we're setting ourselves off on a fool's errand. And so I'll try to cover these three. So this is basically the overview of my presentation, is these three parts of the equation. Now, on that first one with capital, I'll start by deviating away from the topic that I think, or the source of capital that has been the primary focus of both speakers before me, which is bank funding and capital from banks. Now, capital in a macroprudential sense is somewhat different from the sense that I'm talking about it in. But we're talking about money from banks predominantly in order to fund this industry. Now, Namibia actually sits in a very different position to a lot of the rest of the world when it comes to this, which is that we sit with very substantial contractual savings, and so both discretionary and non-discretionary savings relative to the size of our GDP. And this needs to be a key focal point when it comes to the development of this industry. I see some of the asset managers in the audience sweating on the top of their heads already when I talk about this. But it is a very important part of the conversation. Now, if you look at this, Namibia's contractual and non-contractual savings pools, something in the region of 350 billion NAM dollars. So we're talking 20-odd billion, 21, 22 billion US dollars. This is a very significant amount of money, even when you are looking at an industry like the oil and gas industry, which is notoriously capital heavy. So to put this into context, the savings of the Namibian, the contractual and non-contractual savings, could buy, if it made commercial sense, and this is a point that I'll come back to repeatedly, could buy literally hundreds of oil rigs. We could buy literally hundreds of other vessels, platform supply vessels, shuttle tankers, etc., for this industry with these savings. Obviously, that doesn't necessarily mean it's a good idea, but what it does mean is that capital is not necessarily the binding constraint when it comes to investing into this space. And what you can see from the chart on your right is that there's already a lot of money invested into Namibia. But now if you deal with many of the capital allocators that are investing this pension fund money and so on, they're not very happy about their options in terms of where they can invest in the local economy. So perhaps they will be open to looking at other opportunities. I see a couple of heads shaking in the audience. The second part of this is, of course, what's been discussed already, which is the banking sector and the assets of the banking sector. Now, obviously, in this audience, I don't need to talk about the fact that these are not unowned assets in the same way that I shouldn't talk about the national savings of the country as if they belong to the country. They belong to the individuals of the country, and on the bank side, the funding of the banks belongs to individuals, not money from the magic money tree. But at the same time, there is a lot of money there if we can structure it in a sensible manner that allows it to be utilized in a manner that generates the return that the owners of this capital seek from it. And specifically, if those owners can be adequately compensated on a risk-return basis. Now, one of the reasons that I don't think we should be too focused on the banks and the banks alone is the banks do tend to play in a much more risk-constrained environment, and they also are unable to take additional return upside in the same way that the non-banking sector can do in certain instances. So the implication of this is that pension funds with long-term liabilities are able to be a lot more patient, take on more risk with the potential of more long-term upside. So we should always talk about risk and return together, but banks are not necessarily always as well positioned to capture the upside and therefore can't take as much risk as some of the other institutions and the other funding can. So the implication of this, I think, is that there is capital in Namibia. There's the commercial banks obviously have capital, pension funds, insurers, asset managers, and then private savings as well. So as well as all of the contractual money, there is private capital, high net worth individuals, individual savings, which may be willing to go and play in this oil and gas space. And I would go as far as arguing that capital for ownership of significant portions of the value chain is probably not the single biggest constraint. And especially when you consider that around the world, syndication in various different forms is very normal. So if you want to buy a rig, for example, you don't need to provide all of the capital in order to have significant Namibian ownership or Namibian interest in it. So one can easily bring in additional capital, share risk, etc. This need not be the most prohibitive factor, and I would argue in Namibia it's not the most prohibitive factor. So then what I've been primarily asked to talk about, but is definitely the most kind of complicated, is the intermediation channels. Now, if you follow what we do, the kind of joke, you'll know that my colleague is Ramey, and the joke is all complicated transactions, all roads lead to Ramey. I just take the credit for it by doing the presentations, apparently. But the point here is what we do is put together structures for kind of complicated deals, whether it's abattoirs or oil and gas related deals or mines or whatever it is. That's very much our kind of specialty. And so intermediation channels and structures are a kind of key part of this equation and probably the single most important part. So in order to understand this, I think it's useful if we talk about the kind of two extremes of the investor world. So I've outlined these. Don't please take this the wrong way. It's not meant to be offensive in any manner. But on the retail, the high net worth retail investor side, you tend to have very decisive people, very decisive capital. It tends to move fast. It makes decisions quickly, a high risk appetite, but generally relatively small tickets. Individuals rarely make, tens of millions of US dollar investment decisions, especially in our market. And it's difficult to aggregate in our space because small population, lots of inequality. There are not that many wealthy people that can make significant capital allocation decisions on significant amounts of money. They tend to be relatively structure insensitive, and initially I had they are unregulated, and I was told I should not say that. I should say that there's limited regulation of these entities. But they are certainly less regulated than the other extreme, which is your large institutional type investors. These larger institutional investors tend to be more indecisive. They tend to have much longer, much more complicated processes. They tend to be slow to make decisions, painfully at times. They tend to be very risk conscious, driven by mandate often. So the last thing you want is to be the party that took risk and it went wrong in our environment. That's not necessarily true globally, but certainly in our environment. But they can generally do much larger tickets. So they can do the tens of millions of US dollar type investments, whereas the private high net worth people are less able to generally. They also tend to be very structure constrained. So institutional investors, there's a lot of regulation around how they may invest. So while a retail investor might come and give you $1 million US into your CC that may or may not have decent financials and up-to-date financials, an institutional investor will certainly not do that in many ways, thank goodness. And they are highly regulated. So the structures and otherwise highly regulated. The oil and gas industry is very like the mining industry in the sense that the vast majority of the capital that will be deployed into this industry, if you want to capture significant value chain, will have to be in the big ticket items. There are things around the periphery that smaller businesses can do, which we'll talk about in a moment. But many of the investments actually focus on these larger capital needs. And the implication of this is that one can't rely on the retail high net worth as much as we will need to look at the institutional investor space and how one can structure things in a manner that's suitable for institutional investors. The status quo, however, I think we have to conclude is not very oil and gas friendly in the same way that it's not very mining sector friendly at the moment. What we see from high net worth investors at the moment is a very sort of schizophrenic position. So on the one side, and I am an economist, so I have to use both hands, but I think that there's some value in that. On the one side, we see that they are very cautious at the moment. Many higher net worth Namibians have burnt their hands trying to invest into Namibian businesses over the last, perhaps 20 or 30 years, because it's not the easiest environment in which to do business. I think we must be honest with ourselves about that. But on the other side, the return potential that the oil and gas industry, much like the onshore mining industry, can develop, these resource rent kind of industries, makes it interesting to dabble in this space. And these higher risk players, I think, are more willing now to take risk in this space than we've seen for quite a long time. And that's both onshore mining and oil and gas. So we do see some risk tolerance and some interest in this space from higher net worth individuals. But to get it to scale is something of a challenge. And I like that comment at the bottom that money flows where money grows. So if there's potential to generate a return, we do see capital being attracted into this space from high net worth investors. But really the key part of the puzzle here is institutional investors. So as I've mentioned, institutional investors are highly regulated. They need to invest via suitable vehicles. And at the moment, there aren't really many suitable oil and gas vehicles available to them. Now, that is something that we're working on changing, and my wonderful colleague will be on a panel later to talk a little bit more about it. But we need to put in place the right sort of vehicles if we want to attract institutional funding into this space. And we are adamant that this can be done, and it can be done in a manner that mitigates the risk and delivers the return that institutional investors need, such that it is palatable to them. And if they are willing to take relatively small exposure and deploy small amount of capital into this space, we think that we can unlock a lot more of the industry than it currently appears we will be unlocking. So the challenge around this, however, is that the structure, establishing many of these structures is technically really trivial. The NSX has done, I think, fantastic reformative work in order to make it really easy to list cash shells, to list vehicles from which to do transactions and similar. But on the unlisted side, it tends to be relatively slow and quite frustrating to get vehicles in place. The other thing with it is that these structures tend to be costly. So there's quite a lot of risk in setting up these structures if you don't have a use for them, if you don't have either an offtake agreement for whatever product or service you'll be providing out of it, or if you don't have the funding coming into that structure. So this is the first kind of point of risk when it comes to these structures. And something else that I think people really need to understand is that the structure in and of itself, so for example, a listed vehicle to raise funds for an oil and gas related project, doesn't attract capital. The structure is a means to an end, but it is not the thing that causes capital to flow. The project on the other side and the capital, so the capital on the one side and the project on the other side, are ultimately what's going to decide whether the structure is useful or not. So the structure in and of itself is not really the biggest challenge, but how you put all of these pieces of the puzzle together kind of becomes critical. But the key point from this is that the structures that we need to do this are trivial. The regulatory process can be a bit slow and a bit painful, but the structure is not really the biggest part of the challenge either. So examples of these structures, generally when we talk about ownership, we talk about equity. So I don't want to make out that the banks are not important, of course they are, but when it comes to ownership of the industry, there's a banker laughing, so thank you. When it comes to the ownership of the industry, equity is fundamentally important, and unfortunately that's not really where the banks play. So there's a lot of different options that we can deploy when it comes to suitable structures. So in the listed space, you have got existing companies. So, you know, theoretically, some of the existing listed companies could go and raise funds in order to expand into oil and gas related activities. We can also easily do main board listing of existing companies that need more unlisted existing companies that need more capital in order to play in this space. So say, for example, let's use a good example of LSS in Walvis and Luderitz. They could easily list and expand in order to raise more capital to play in this space as well. And then there's many or multiple investment structures that we can use on the stock exchange as well. So special purpose acquisition companies, capital pool companies. This is bread and butter stuff for Ramey and the roads that lead to him. On the unlisted side, there's plenty of options as well. So we can do pooled funds, we can do specialized private equity and venture funds for oil and gas. It's risky. Or we can do dedicated special purpose vehicles. There's lots and lots of things that we can do from a structure perspective. Same with regards to the debt side. There's multiple listed and unlisted options. So I'll argue again that the challenge here is not actually so much the structure. And if you have project ideas and similar that you are struggling to bring to life because of an inability to flow funds from those that have it to your project, don't let the structure become the barrier to moving it forward. But we sit with this abundant capital. It tends to be risk averse. It tends to be highly regulated and slow to act. Putting in place a technically suitable structure is not really the big problem. And so we get to the final point of the puzzle, which is there's these new sectors and new companies with new activities. So it's uncertain, it tends to be greenfield, there's inherent risk, and I think many of us realize there's quite a lot of urgency in this space as well. So we can put the structure in place, but the structure doesn't bring about the solution. At the end of the day, Namibians putting together projects and businesses that can genuinely provide goods and services to the oil and gas industry is where the big challenge lies. I have a case study here, but I think I'll actually skip it and talk to projects and procurements. The case study is basically a story of why it's so difficult to build Namibian ownership of mines. And I think that it's a useful case study because it has a lot of relevance when it comes to the oil and gas industry. And basically the story goes that because you couldn't raise risk funds up front, entrepreneurs wanting to play in the Namibian mining sector, Namibian mining engineers, go off to raise funds in Canada and Australia and these known jurisdictions. And in so doing, they register their primary incorporation in those jurisdictions. So a Canadian jurisdiction, for example. Our regulation is such that even if 100% of the assets of that entity are Namibian, it can never be truly classified as a Namibian company because of the country of incorporation. And as a result of that, it makes it very much more difficult for our pension funds and other regulated capital to invest into that space. And these are the types of regulatory things where, and I'm very glad that Honorable Wendo mentioned it, but where the point around now not being the time for rigidity, I think, is so important. We can't let silly wording in legislation get in the way of the development of an industry like this, and 10 years from now be frustrated by the fact that there's no Namibian players in the industry, when it was individual lines of legislation that made it difficult to bring about the development of the local industry. So, thank you, Malcolm. So when it comes to the final part of this puzzle, the project and procurement part of the puzzle, the first thing that I think is very important is that there is something very significant to play for here. And I'm not always sure that we fully understand this and we fully comprehend the details of it. So the scale of this basin is unprecedented vis-a-vis the size of the Namibian economy. So the development of one 150,000 barrel a day FPSO is absolutely enormous vis-a-vis the size of the economy, and I'll show you the numbers on that in a moment. It has the potential to generate very significant returns for people that can play in this space, but there's no guarantee. It comes with significant risk as well. And finally, and I think most importantly, doing nothing or not taking the decisions and the steps needed in order to develop this industry is a cost of sorts as well. And we need to be very careful that we don't sit on the sidelines and watch as an industry is developed offshore Namibia, and we're still quibbling about whether the incorporation of a country, of a company, is more important than the underlying assets of that entity. And so doing nothing and delaying the participation in the industry, I think, also comes with a significant cost as well. Now, the headline or the heading of this slide is, it warrants taking risk. This is not saying there is no risk. It's saying that the potential upsides here and the potential impact on Namibia is such that we need to consider our risk tolerance as individual investors, as individuals, Namibians, but also as institutions. And we need to look at how we can take risk where risk needs to be taken such that we can ultimately develop the industry. And how do we price and share that risk, not how do we avoid it? I made some mean joke about CAs already, but the other CA joke, which I must apologize for in advance, is if you let them manage risk, they'll try and manage it to zero. There is no such thing as zero risk, and this industry, I think, is somewhat similar. I work with a bunch of CAs, and they give me grief about being an economist, so I have to reply in kind. I'm sure you will have all seen the industrial baseline study that was done for some of the IOCs by Deloitte. As the IOCs like to point out, it was an independent study, which I'm sure it was. But that wasn't being sarcastic, for clarity's sake here. The industrial baseline study gives us some idea of where we start. Now, you can't necessarily see the numbers on this, I realize, but I think that you can download this online and you can look at it. This gives us some idea of where we start, and I think that that's fine. However, it doesn't truly encapsulate where we could go and how we could get there and do so relatively quickly. One of the things that bothers me with this study, and there are a number, but let's not get too carried away. I've already been mean enough about auditors or CAs. But one of the things that bothers us about this study is this point that is made, where are we here? Here, that there will be a 1% increase in Namibian GDP if FID is reached by Total for one FPSO. So 1% increase in GDP. Now, fortunately, I'm confident that the study is about an order of magnitude out when it comes to that assertion, which is a relief in many ways. And the reason that we say that is if you just look at the quantum of the decision to be taken here. So the Venus FID would be something between 10 billion NAM dollars, a capex estimate, and between 17 billion in capex and capitalized OPEX. So very significant numbers versus Namibian 2025 GDP, the latest that we have, that's 64% of Namibian GDP, or 109 on the top end, including the capitalized OPEX. And the project NPV is upward of 50 billion. You can calculate it more or less yourself, judging by the number of barrels, the oil price, exchange rate, etc. So very, very, very significant. To say that we will only see 1% growth from this, it's clearly incorrect. I think that's the first thing. So once FID is made, we will have significantly higher growth, and much of it will be as a result of oil and gas related activity directly and indirectly. So that's the first thing, that's good. But it also contains a concerning admission, which is that Namibia is expected to capture very, very little or almost none of the initial spend. And this is something that I think we should be looking at and looking how we can change that. Perhaps that is the status quo, but what can one do in order to influence that? The ongoing expectations around GDP is 5.8% growth for 2 or 3 years. We also think that that's probably about 50% of what it will actually be, but it's very conservative. But it's a lot closer. But on the initial investment, we think it's out by about an order of magnitude. The key thing here, however, is that it requires genuine willingness from the counterparties, from the IOCs, from the tier 1 contractors, etc., to develop local capacity along the way. And this is something that we can put together all the structures that we want. We can put together, or we have the capital, as we've discussed, that we need in order to play more of a role here. But if there isn't a willingness to procure from Namibian entities where Namibian entities can play, none of it matters. We see 1% growth while a spend of 109% of GDP takes place. And this is really the kind of crux of the matter that we need to look at. I think we can skip this. It's on our website if you're interested. When it comes to this willingness, again, the industrial baseline study shows the kind of timelines around this. And that red line is the FID point. And much will happen post-FID. However, if you listen to the Total earnings call, I've highlighted it in red there, the recent Total earnings call, they say, we have selected all contractors already. So this puts Namibian and Namibian entities in quite a tricky spot. You're now caught in this catch-22 web. So you can't go and get a contract from Total because they haven't made FID. So you can't go and borrow money or get funding for some service that you wish to provide. And without the service, you're not going to get without the good or the service, you're not going to get a contract anyway. And so you can't break in and you can't develop a track record. If the decision of contractors is made pre-FID, how do Namibians get involved in this space? And this becomes a kind of important question and an important consideration around this industry going forward, is how do Namibian entities break into it, and how do we break this cycle? And most importantly here, who takes that risk along the way? We can go and buy vessels to provide services to the oil and gas industry. That means that we carry 100% of the risk. Is that right? So risk and risk sharing. The big question when it comes to risk and the risk sharing here is, should the Namibian project originators, the Namibian investors, Namibian intermediaries, take all of the risk of starting to develop up a Namibian industry? And I would argue the answer to that is no. I fully understand that IOCs have processes that they follow, and I fully understand that they're not going to give away tenders to Namibian entities pre-FID and things of this nature. But to say that there's no opportunity post-FID, that becomes somewhat sinister, if you ask me. And I think that this is something that we need to be questioning. Now, Namibians like to tell you that it's our oil. And I had some very heated discussions with the Parliamentary Standing Committee on Natural Resources a few years back, where one of the members hit his hands on the table and he said, but it's our oil. And I said to him, Minister, then I suggest you go and get it. And there was this awkward silence, and I realized I had probably somewhat overstepped. But it was an important point. And once the sort of dust had cleared in the room, he said, we need partners. And that's completely correct. No, Namibia is not able to go and get this oil on our own. But we should be looking at conditions when it comes to other people utilizing the oil. I see I'm being given the clock, so I'm nearly done. And we should be looking at conditions when it comes to it. And some of those conditions should be risk sharing around genuine industry development from a Namibian perspective. So perhaps put aside some of your standard global operating procedure around this and allow a little bit of risk when it comes to appointing Namibian entities, perhaps pre or post FID, such that we can start to develop up the local industry. And when we're talking about local content, we are, much like Honorable Minister, talking about genuine local content. We're not talking about, as it's termed in our office, briefcases and markups. We want genuine local content. And I'll skip past some of this because I'm short of time. So the IBS certainly identifies some opportunities, but again, the way that this was summarized by some of my team members is the IBS says that we can cook food for the oil and gas companies and the tier 1 contractors, and we can store stuff for them. That's not really good enough. And I tend to agree with that. And if you look at a lot of what is captured here as things that are complex and that we're unlikely to be able to do, we fundamentally disagree on a lot of this. A lot of this stuff is actually capital intensive, but not actually technologically that complicated. And if you look at how much of the industry works, the ownership of capital assets and the operation of capital assets is often not completely the same. So that gives you interesting ways in. So if you take, I've used the oil rig as an example a few times, but if you had a Namibian-owned oil rig, it would not necessarily need to be Namibian-operated from the outset. It can be operated by a global player with backfilling Namibian expertise over time, such that you develop up the local industry. But to say that Namibians can't do it, and that Namibians don't have the capital to do it, and that we can't put the structures in place for it, is factually incorrect. And I think that this is something that we need to be looking at. We also need to be realistic about a number of things, and probably should be realistic about everything, really. But there are some cultural things that we also need to think about from a Namibian perspective. As much as it's our oil, and absolutely it is, but we do need partners to help to get it out of the ground. As much as it's our oil, Namibia will likely produce, with one FPSO anyway, 0.15% of global oil supply. So we have to be realistic around the role that we're playing in this industry. And we need to realize that we also must change to suit what the rest of the world is doing and not expect them just to dance to our tune. Namibia is the land of the brave and we're great and everything, but we are imperfect like every other country. And there's things that we should be looking to do to improve. Speed of execution when it comes to things like investment decisions on structures. I'm not talking about this from now the government perspective, I'm talking about this from an investor perspective. Speed of execution is hugely prohibitive. When we look at buying an asset from a foreign entity to partake in the oil and gas space, they tell us that the norm to buy or to transact on an asset like this in Norway is 2 months. 2 months from the day that you meet to the asset changing hands. Very, very little happens in the Namibian financial sector in 2 months. You might get a meeting with your bank. The regulatory side, I think we've touched on, and I think that this is something that we do need to look at. How do we make it easier for, and how do we allow the non-bank financial sector specifically to take additional risk when it comes to this space, knowing that there is potentially very meaningful upside, and not view risk as something that you want to manage down to zero, as perhaps the CA might, but that the potential returns that you can generate are very significant, and as a result, we need to consider our risk tolerance. And the final point is our willingness to take risk generally. So my conclusion is one slide, here we go. There is plenty of money in Namibia. Money is really not the problem. It comes from all of those different sources that you can see there. Structures are not the problem. All roads lead to Rame. Projects are more complicated, and the development of projects, I think, is really where a huge amount of the focus needs to be. How do we create goods and services, build businesses that create goods and services that are globally competitive and provide what the oil and gas companies actually need? and that they are willing to pay for in a cost competitive manner. And it is very possible, it's very doable. We're working on a number of these things at the moment. So it's very possible. We're not asking the oil and gas industries to employ people or employ entities that double or triple the costs or that aren't technically compliant and so on. We want to produce the goods and services that the industry needs, legitimately produce those locally as best we can. And that requires Namibian entrepreneurs and Namibian risk takers. Now, when we got involved in this industry, people said to me, what the heck do you know about it? And I told them I know absolutely nothing. I know about the financing side of it, but I don't know anything beyond that. But if we don't roll up our sleeves and get involved, this will 10 years, 15 years, 20 years from now, we'll be bemoaning the fact that there's no Namibian activity in this space. So roll up the sleeves and build the businesses. And then risk and pace, I think, is absolutely critical. We need to look at risk sharing when it comes to this. It's not good enough that the Namibian entity must take all of the risk. We need to look at how, if, for example, I keep using the oil rig example, we'll list an oil rig tomorrow if we can get the right offtake agreement. But if there's a suitable oil rig available, let it be preferentially procured, let the risk be shared between the different entities, provided it's technically suitable, provided the pricing is competitive. Let's push in that sort of direction such that the risk is not just carried by the Namibian entity when it comes to trying to get something more than the taxes and similar out of this new and very exciting industry. And that's the end. So thank you very much.
Roland, thank you very much for that insightful presentation. I have never been this thrilled to be an economist. So key takeaways from your presentation is that Namibia's challenge is not necessarily a shortage of capital. You have said it well that it's really the how that capital is structured, channeled and matched into credible projects. Meaningful local participation will require suitable investment vehicle, genuine local capability, faster execution, and a willingness by investor, operator, contractors to price and share risk rather than avoid it. You have also challenged us to think beyond narrow definition of local content and to really position Namibian businesses to provide competitive, world-class services across a much broader segment of the value chain. So thank you very much for that. Ladies and gentlemen, we are slightly running behind schedule. It's now at this juncture that we will take a 10 minutes break. It was supposed to be 15 minutes, but we'll make it 10 minutes and we'll be back here at 33 minutes past 11. Thank you. Ladies and gentlemen, if I can invite you all to please take your seats so we reconvene with our program. Thank you. Ladies and gentlemen, a humble request for us to please take our seats so we reconvene. We will be starting in the next 30 seconds. Welcome back. We will now proceed to the panel discussion. The panel discussion is under the theme Financing Namibia's Oil and Gas Future, looking at the opportunities, the risks, and the partnerships. The discussion brings together perspectives from government, banking, the petroleum industry, and local enterprise. The session will be moderated by Mr. Elia Pavo. Elia is a banking supervision professional, strategist, and regulatory leader with more than 13 years of experience in banking supervision, financial sector development, strategic risk oversight, and financial risk management. He currently serves as a Deputy Director of Offsite Analysis within the Banking Supervision Department at the Bank of Namibia. Throughout his career, Elia has led and contributed to several landmark regulatory initiatives, including the implementation of Basel III liquidity standards, the integration of climate-related financial risk into banking supervision, and the reporting of business credit information to the credit bureaus, amongst others. His expertise in prudential regulations and financial sector policy has also been recognized internationally through his appointment as a short-term expert to the IMF Capital Market Division. Elia, please join me on the stage. Thank you. Over to our panelists. First to join us on the stage, Mr. Carlo McLeod, Presidential Special Advisor and Deputy Head of the Upstream Petroleum Unit in the Namibian Presidency, where he supports strategic direction, regulatory oversight, and institutional development of the upstream petroleum sector under the authority of the President. He has over 20 years of experience across petroleum law, public administration, and natural resources, including senior roles as the Deputy General Manager of Chevron Namibia and Deputy Director for Petroleum Affairs at the Ministry of Mines and Energy. Mr. McLeod holds advanced degrees in oil and gas, Law and Public Administration from the University of Aberdeen and Mines Paris Tech, respectively, as well as law degrees from the University of Namibia, and is completing an MBA at the University of Science and Technology. Mr. McLeod, please make your way. Ms. Berenice Hans is a chartered accountant and transformative banking leader who has played a significant role in shaping modern financial services in Namibia. She is a former managing director of Bank Windhoek, where she led one of Namibia's largest financial institutions through sustained growth, digital transformation, and innovation. She also held executive leadership roles at NamPower and Standard Bank Namibia. Ms. Hans has served on numerous public and private sector boards and is widely recognized for her expertise in strategy, governance, and financial markets. As the first female managing director of Bank Windhoek and the first woman to lead one of Namibia's top 4 commercial banks, she presided over a defining era in the country's banking sector. Ms. Hans, please join us on the stage. Mr. Eduardo Rodriguez is a country chair for Shell Namibia and chairperson of the Namibian Petroleum Operators Association, NAMPOA for short. With over 24 years at Shell, he has held senior leadership roles across integrated gas, upstream and downstream businesses in Latin America, Central Africa, and the Caribbean. His current focus is on advancing Namibia's energy sector through strategic collaboration between government, the broader oil and gas industry, and other key stakeholders. Eduardo holds a Bachelor's of Science in Manufacturing Engineering from Boston University and an MBA from Georgetown University. He is a strong advocate for local content, social investment, and sustainable development. Mr. Eduardo, please join us on the stage. Ms. Taimi Itembu is a seasoned policy advisor and global communication executive who has built her career at the intersection of government, business, and social change. She currently serves as a global communications lead for ExxonMobil in Europe, where she shapes strategy across the EU, Hungary, and Czech Republic. Before stepping onto the global stage, Taimi was already breaking ground at home in Namibia, becoming the first youngest advisor to executive teams across parliament, the judiciary, and national education institutions. Her leadership has influenced national policy reforms, international partnership, and groundbreaking projects, advancing governance and equity. A Harvard graduate with various awards from the university, Taimi earned multiple honors, including the Edmund, Curley, and James Gallo Memorial Awards. She chaired one of Harvard's largest African Development Conference and was selected as the 2019 graduation class speakers. Ms. Taimi, please join us. Elia, the session is now in your very capable hands, including the Q&A session after the session. Thank you very much.
Thank you, Jason. Now, Mr. David Kalyango has implored us to speak the oil and gas language. And those of us from the banking and finance background, I just have a small assignment for you. 3 concepts, so that when you go back to your families at the end of the day, you should be able to demonstrate to them to say, indeed, I attended an oil and gas seminar. So number 1, porosity. Number 2, permeability. Number 3, viscosity. So if you ask me what that means, I also do not know, but ChatGPT is probably your best friend at this point. Ladies and gentlemen, I would like to begin by asking a very simple question. When the first barrel of oil is produced in Namibia, will the banking sector and the financial system at large be part of the conversation? Or will we merely be a spectator? I think that Tom spoke to that. But to help me answer that question, I have a very capable panel before me here today. And you know, I'm a soccer fan, by the way. And at the ended World Cup, they just ended World Cup, I was supporting the French national team. So when you see the lineup, you see Mbappe, you see Olise, you see Ndebele. So in football terms, we say the lineup is stacked with talent. So the panel before me here is stacked with top-tier talent, with expertise ranging from global energy markets, banking and finance, public policy, and maritime services. Ladies and gentlemen, our discussion today centers around the theme, financing Namibia's oil and gas future, opportunities, risks, and partnerships. Without further ado, let's dive straight into it. And my first question goes to all the panelists, and probably starting with Taimi. In less than 1 minute, what do you believe is the single biggest opportunity that Namibia's oil and gas industry presents for the country's financial sector, and why?
All right, good morning, everybody. It feels great to be here today and to see a lot of my mentors and leadership in the crowd today. Maybe just to a quick point of clarification, I no longer work for ExxonMobil. And I'm the least nicely dressed up here because I'm the entrepreneur. So I run Zephyr Marine Services, which is a platform supply vessel company. And so maybe just to your question, Pavel, I don't think, not so much an opportunity, but the smart play, since you're talking about soccer, the smart play for us right now would be Namibian participation in the high barrier to entry, so sort of your tier 1 services. And that's exactly what we're trying to do as a company. That, though, for the game to actually be played and for us to win that game, we need to make sure that we legislate the readiness. So we need to have policy backing entrepreneurs to make sure that we can actually participate alongside our international competitors and partners. Secondly, we need to make sure that we're financing that capability, at least most of it at home, because we see this every day. We have so much value moving across this industry every day, and we're losing the value for that because we don't have the policy that's mandating it. And more specifically in terms of looking to get into these high barrier to STEM-related offshore services is because that's the only place that we could really fundamentally hone in on the technical skills that will last. And I am a firm believer, Ricardo Hausman, which I think is very familiar around Namibia, is that at the end of the day, capability is the only permanent form of economic development. Everything else will leak, financial or revenues will deplete, and we will have financial fleas at some point, but the only thing that moves between people that compounds the more it is used will be that technical know-how and capability.
Thank you, Taimi. Mr. Rodriguez.
Thank you very much. Good afternoon or morning still. So most of the things that I'll be talking about I'm repeating. I'm repeating what I've said in the past, and I'm repeating what has already been said. In my country, one of the most successful presidents, in my opinion, said repetition, repetition, repetition. And when I get tired of repeating, people start to listen, right? So I think alignment and working together is the biggest opportunity. Now, to the question, and I'm going to quote some of the things that has been mentioned already. I think the most important thing of this industry, as Roland was saying, it is the revenue that this industry can create for the nation. Just to use the example of Uganda, I believe, has 53 million people. And the GDP is $77 billion US, and is going to produce, I understand, a peak about 240,000 barrels. Namibia, on the other end, has a little bit over 3 million. The GDP is 13 billion, so, significantly lower than Uganda. And the production is still to be determined, but could be much higher. So that tells a little bit of the magnitude of the revenues that can represent for the country. And clearly, the Bank of Namibia plays a very important role on how those revenues will be managed and how is it going to be invested. how the economy is going to be diversified and it could be transformational if it's done correctly. So I think that's the first big opportunity. And the second one, a segue to my colleague Roland, the first IBS industry baseline study was triggered by 2 oil and gas companies just to get the ball rolling. All right, but that was back then 3 years ago. And quoting Mr. Caliango's words, map the full value chain. That's what we're trying to do, and that's the biggest opportunity here. And that's what we're trying to do here with Mr. McLeod, with the UPU and the key stakeholders, which is we're going to try to do an industry baseline study 2.0, where it includes all the stakeholders so that we can properly map the value chain on where everything participates. Because the other thing that I've heard in this conference and in finance institutions is risk and how that money is going to be invested. So we have to map, not by opinion, but by data-driven, how the industry is going to work and what is expected in the short, in the medium, and in the long term, so that value chain, that supply chain can be mapped. And we're in a unique opportunity, and personally, as an investor, in the many jurisdictions that I work, I think this is the best practice, and we gotta cherish it, that government and the investors, as well as service companies, are working together to try to build this roadmap that should be the center roadmap for policy generation. And that's, I think, one of the biggest opportunities that we face here that match with what everybody has said. And to finish my introduction, I'm going to quote Honorable Tom Olwendo, which he said one word is prudence. We have to be prudent in this very high risk industry that we will talk a little bit more later. Thank you very much.
Thank you very much. Good afternoon. I think it's 12 o'clock now. And for me, this is absolutely a once-in-a-generation opportunity overall for Namibia as a country, especially for the financial sector. And the opportunity for the financial sector overall is really how the sector itself can be transformed by oil and gas. And why that is important is the role that the financial sector plays in transforming other sectors, as has been said earlier. So the single biggest opportunity is really the transformation of the sector, the disproportional impact the sector could have once it's deepened, more diversified, new skills are introduced. So positioning the sector for this opportunity and making sure we actually participate and are not on the periphery, as has been said, is the single biggest opportunity. And it actually multiplies and has a disproportionate impact across our economy.
Mr. McLeod.
Thank you and good afternoon. I think from government's point of view, it's quite clear. We have the national development plans and we know what government wants to achieve. And what we want to envisage as the single biggest opportunity for Namibia is to see that the oil, our oil, becomes an enabler for the economy. But because of that, we would want to depend on the financial sector to be the catalyst to ensure that, the opportunities that is presented in this particular industry is harnessed and it is used optimally by all, especially by the citizens, but with the financial backing and assistance of the financial sectors and the banks. Thank you.
Thank you, Mr. McLeod. So, Tammy, you indicated that capability is the only form of economic development. Mr. Rodriguez, mapping the value chain using data. That's a key point. Ms. Hans, transformation of the financial sector, and Mr. McLeod, all becomes an enabler for sustainable economic growth. So moving on, Mr. Rodriguez, if I can focus on you for now. Namibia's recent offshore discovery have generated significant interest. And without asking you to comment on Shell-specific milestones, appraisal outcomes, or FID timing, could you help the audience understand how deep water projects typically progress from discovery and appraisal towards a potential investment decision, and what that means for how financing opportunities may emerge over time?
Yeah, sure. With pleasure, I'll do that. And it's, I think, a very important question to understand the industry, especially the risk profile for the investors and the companies that are starting up. So just to put it in context, so Namibia, the Orange Basin, it's you already have a petroleum system that is discovered. So the risk profile goes or lowers a bit, so the uncertainty increases. But for example, we have the rest of the country. The Orange Basin is a third, right? So let's say the Luderitz and Walvis Bay Basin, which is still a frontier, still Namibia, but still frontier. If a block is awarded tomorrow, right? Tomorrow, we're talking about if all goes well, which never does, right? Which never does. But if all goes well, a reasonable timeline, you're talking about 14 years for first oil, if all goes well. So why is that? Because you start first with an exploration contract that has 4-year term, where you have to acquire seismic, then you have to interpret it, then you have to identify your prospects, and then you have to be sure enough that all that study that you've done in those 4 years will give you that prospects that will encourage you to drill that first well. Because when you're moving to the next phase, usually you have to commit to a well, right? So then you have to convince your investor that you want to drill a $100 million well that's dry cost with a 10% possibility of success. So I will ask here any of the banks, if I come with that proposal, who is willing to jump into that venture? Not many, right? But you have to do it, and that's how the business works, right? And that's why Namibia had to have attractive terms to compensate for that risk. So let's say that, a company said, okay, I'm going for it. Then you go to the extension of the well commitment, all right? And then you drill the well, and then everything goes well, and you find a discovery, all right? Which usually is not the case. 1 out of 10 wells are successful, right? So that's why the 10% possibility. So then with that, if it's successful, then you have your 2 years, and then you have another 2 years to do a appraisal activity or further exploration or interpretation. And then after that, you have to be sure that there is a commercial development, which, as we have seen, Uganda, I think you mentioned 1920, started the exploration in Uganda. Namibia, we're talking in the 70s that started with the Kudu discovery. And so timelines take much longer. But let's assume that it's successful, so then you have another 2 years, right? So we have 4 plus 2, 6 plus 2, 8, all right? And then you gotta go declaration of petroleum field. You have another 2 years to do a FID development and try to understand that. That's another 2 years, so that's 10 years. And then you do FID, and then you gotta go build the stuff, right? You gotta go get the FPSO, which is the most one of the most relevant units, and that takes around 4 years. So you're talking, if everything goes well, you're talking about 14 years before you can produce the first drop of oil. So the life cycles are huge. And that's something that is really important to understand, because there's different risk profiles in the oil and gas life cycle. So we are still in Namibia in the exploration and appraisal phase. No FID has yet been declared. We are all working really hard, and that's our objective, right? But yet so that means a lot of uncertainty, that you don't know what's going to happen. So the risk profile is very high. So as a nation, our recommendation is you have to make sure that you have the right terms to give the certainty, to keep the capital coming in, because the more seismic you do, the more wells you drill, the higher the chances of success you will have to make the pie bigger. And that takes a good partnership, as we have had with Namibia over the last years. The daunting task Namibia has drilled more than 28 wells in 4 years. That's a daunting task, and that doesn't happen from night to day. It happens with the reputation that the country has built, with the agreements, with the conversations, with the dialogue that we're having. And that encourages the investment attractiveness of Namibia. So in this investment phase, the key priority should be trying to attract as much investment and be as competitive as possible. So financing opportunities, there's many, but the risk profile changes. Probably in the big investment, when you're talking on an FID, 90% are metal investments, right? So the wells, the FPSO, the SURF, but there's a supply chain around it, and that's where we have to be working on, and that's where the financing opportunities. The Bank of Namibia has a big responsibility on sovereign fund, on how the money is going to be managed, the proper policy, the proper regulation, because the incomes are going to be huge. And again, I go back to the industry baseline study and the importance of it. If we're able to visualize how the future looks and where those opportunities are, companies like Time's company and the finance sector can organize themselves to see where there's a place to invest and to play an important role. For example, in the industry baseline study, we see that working capital is a problem, is a challenge. Well, ideas of the finance sector is if I have a contract with a supplier, then the supplier has a problem with working capital because we have 60 days of payment terms. But if the supplier has a contract with the company, then they can guarantee the working capital. So that's a very clear example on how a finance sector can work with the supply chain. So I think that the opportunities are immense, but we have to work on this together. We have to be prudent. We have to understand in what phase we are. And we have to understand how we play the game to make sure that Namibia doesn't lose their competitive edge while maximizing their local resources.
Thank you, Mr. Rodriguez. Clearly, the life cycles that leads up to oil productions are huge. And on the brighter side, that gives government enough time to prepare. Mr. McLeod, with that in mind, could you explain the objectives of Namibia's local content policy as it relates to the financial sector? Specifically, what role does government envisage for Namibian banks and the broader financial sector across the petroleum value chain?
Okay, thank you. We should know that historically, development and production has basically just been about taxes and royalties. That is now under a concession system. That is also the system that Namibia is currently employing, the regime, tax and royalties. However, with time, governments, especially African governments, have realized that there's more value that can be captured other than just relying on taxes and royalties. There are businesses that are around the extraction that can add value to the economy, that can create backwards and sideways linkages. And that is exactly what the Namibian local content policy is all about, is to capture that value and to make sure that Namibian businesses are also taking part of the value that is created in country. Now, the policy is not about tax collection. No, it is about creating value, like I said. And where the financial sector comes in is basically threefold. We at government would want to see the financial sector provide the lending to SMEs. We have seen that there is not a lack of will on businesses or SMEs to do business, but there is a lack of capital for them to do the business. And the local content policy is basically putting that, onus on the financial sector to unlock that opportunity for the Namibian SMEs to participate. Secondly is on the issue of insurance, very important. A lot of risk is being insured outside the country, and there's a lot of premium that is being lost there for Namibia. We would want to see insurance companies, at the minimum, starting with underwriting some of these assets and risk, also to take part in that. And then the third aspect is retaining capital in a country. Retaining capital through making sure that salaries are paid within Namibia from Namibian banks, that foreign exchange is retained here, that project accounts are opened here in Namibia. That is what we want to see, and that is what we expect from the financial sector. Thank you.
Thank you, Mr. McLeod. I think what is quite key is that lack of capital for SME financing, and I think moving on to you, Ms. Hans, Rowland indicated that the banks are possibly not the best suited players to finance oil and gas. Now, given your extensive experience within the banking and finance industry, where along the oil and gas value chain do you believe Namibian banks can add the greatest value while remaining within their prudential risk limits? Which opportunities do you see as both commercially viable and realistically achievable for local banks in the near to medium term?
Yes, no, thank you very much. And I think that I'll start by saying that first and foremost, banking institutions are deposit takers. And that hence all the, I suppose, the prudential regulations around safeguarding deposits. So banks can actively play a role as deposit takers in terms of the inflows of foreign direct investment. And if I start there, I would like to just comment on one thing. And the opportunity currently is a bit limited because in as much as the IOCs should and will always choose their banking partners, what we do see is a concentration of inflows. So my opinion would be that that should be more distributed from the outset. That's the starting point. The second is in terms of lending, which is now the other side of the balance sheet, is where could banks participate? And as many speakers before myself has said, in the lending space, near-term working capital is definitely an opportunity, a massive opportunity. It rests on what Roland said around local content participation becoming a reality. I must be honest, I've sat in many conversations in boardrooms where there's a lot of fluffy talk around local content, and I think we need to get real about this. The opportunity rests on the role I think that IOCs will play and continue to play, and that needs to become real in support of the policy that government is pursuing. So working capital, what's quite attractive about supply chain contract-based working capital is that these deals are self-liquidating. So the requirement for collateral is much less. So at the outset, normally SMEs struggle with collateral. And when you do have the presence of a strong off-taker, it does de-risk the deal substantially, and to the extent that the deal flows actually provide the repayment for the loan. So that should be a top-of-mind opportunity for most of the banks to participate in, and they already do. So when it comes to trade finance, I think many speakers have spoken to it. A lot of what we already see in the financial sector would become available to SMEs, asset-based finance where their infrastructure requirements would also be quite attractive, assuming that the underlying asset is productive and generates the returns that would service the underlying debt. When it comes to the bigger, and that will probably be more in terms of the value chain, and I also would like to emphasize some of the earlier comments around understanding the value chain, but also understanding the risk. And as Mr. Brown has said, I'm very nervous talking about risk as a CA after his comments. Deeply ashamed to talk about risk, but if you do have to look at the risk and the return. So typically banks cannot take risk that other financiers or other financial services should be taking, especially when it comes to equity risk. And therefore, I think one of the key answers to how especially banks could participate going forward is really partnerships. And we mentioned syndications, both international, local. This is not unusual. I can give an example. A few years ago, we actually did a syndicated deal for the Benguela Gem, which is the vessel that De Beers Marine deployed a few years ago. Very successful. So this is not unfamiliar. The industry is well versed with syndications. It's just the frequency and scale that would probably change in this scenario. The other would be also, I think, if you look at opportunities beyond syndication, is partnerships with DFIs to de-risk. We spoke about risk structures such as off-balance sheet risk structures such as guarantees. So those all come into play, and they are also very familiar. They're not unusual instruments that the sector uses. But I think ultimately, if you look at the financial sector in totality, and if you look at the contractual savings that Roland also mentioned, what I've seen is an absence of equity capital, and equity actually makes deals more bankable. So we do need, through partnerships, through capital market layering, different types of capital to attend to different levels of or types of risk, and to make sure that all those types of capital are available and involved to ensure, especially participation in the more riskier deals. Not initially, I wouldn't initially advise that banks get involved in, I suppose, the upstream side of it, but over time, there should be some convergence towards participating in midstream and upstream, although initially that might not be the case. And even if you look at supply chain finance, the ticket sizes, given the absolute size and you know, what's an exponential impact of oil and gas on this economy, even the ticket sizes, when you look at the domestic value chain, could become substantial, and they will require partnership. So the enemy of participation here will not be scale, it's isolation. It would really be how we think about partnering, working together, and the types of capital that need to be deployed to realize these opportunities for SMEs as well as for other clients.
Thank you, Ms. Hans. Mr. Rodriguez, I just want you to reflect quickly on what Ms. Hans said, and obviously take into consideration that I think we've been warned to say upstream is capital intensive, high risks. So if you can just segregate it for us to see, where do you foresee international financier playing and the local financiers?
So for example, as Shell, right? Shell has their global balance sheet, right? And then they structure their debt and financing on a global basis. And then projects get financed to be invested according to, if we inject capital or parties' debt, and you know, those depends on treasury optimizations of the investor, right? That's basically what we do. So where I think, and then clearly, you know, we have, you know, companies use banks globally, 2 or 3 banks globally, and then they have agreements with local banks, and that's how it works. But we're, you know, I was saying earlier, the biggest opportunity is on identifying in the supply chain, which is a significant amount of where this, you know, at the end, if you do an FID, you're talking about 10. To quote the numbers that Roland used, 10 in CapEx and total with OpEx and everything, 17 billion on the numbers that Roland, there's a significant chunk on suppliers that can attend that part of the cost and investment part. Just to give you an idea, Namibia is not starting from zero, right? You know, there's other countries that I work that clearly they don't have a port, right? Here we conducted, at some point, there were 4 rigs operating out of Namport and Walvis Bay, which is truly remarkable. So you do have a solid infrastructure. That the fact that Namibia doesn't have infrastructure, that's not true. You have already a strong base. Suppliers, for example, aviation, which is usually not, it's a very sensitive supplier for the operators. It is 100% Namibian, right? Integrated logistics, which is not, you know, it's not catering, as Mr. Roland pointing out, that is feeding the oil and gas industry. This is complicated and very high risk activities with huge liabilities. 1 day of a rig operation costs $1 million. So if everything is not running smooth in terms of transporting people, in terms of coordinating the logistics, then you stop operations because safety goes first. So those are critical facts that are being done by Namibian companies already. And at the end, it expands. For example, even in well construction, the supplier of barite, which is the a component that goes into the construction of the well, it's a Namibian supplier. So, you know, we're already doing. So I think, and I always said, let's don't be too hard on ourselves. You know, the baseline is solid. The discussions that we're having are solid, and the opportunities in the supply. I'm sorry, I'm getting excited because that's a topic that passions me. But for example, there's already an association called COGANAM, which is the Contractors of Oil and Gas Association of Namibia, which is an association of all the companies that will be in the supply chain that are uniting to work together with the operators and with the UPU. Right, we have a quarterly cadence to follow up on all these topics that we're working on. Local content is one of them. So we're having the right discussions, and if we're able to continue executing the plans that we have, that's why I insist so much the importance of an industry baseline study. That will be the roadmap to identify the mapping of the value, the supply chain, to understand where you can play and what risk it can be associated. And as Roland pointed out in the other IBS, you have the low-hanging fruits, and then you have the ones that are maybe not at this moment appropriately. So if we work all together in a coordinated manner, we're doing a great job, I think.
Perfect. Now, your point that Namibia is not starting from zero ties in perfectly with Taimi's recent interview at the NAGA magazine, where Taimi expressed that we already have expertise, maritime expertise, especially coming from offshore diamond mining and also coming from fisheries that can be transferred to the oil and gas industry. With that in mind, could you elaborate on which specific skills, capabilities, and service offerings you believe are most transferable to the oil and gas industry, and where you see the greatest opportunities for Namibia businesses to establish a competitive advantage within the offshore value chain?
Thanks, Pavo. I think maybe just a point of clarity on that is that transferable does not mean transferred. But the point that I was trying to drive home with that is that Namibia is not starting from scratch, which is what both Berenice and Eduardo have pointed to, and that we need to lean into that more confidently with, the decades of offshore mining that we have in fisheries. So we have a sizable marine skilled workforce, whether it's captains and crewing, surveyors, divers. The list is endless. But that also goes to say that I think what's paramount to that point, and what Eduardo actually said right now, is that maybe it's time, and I'm sorry to ruffle feathers, I work and share a desk with Roland, but we need to sort of hone back a little bit on the fact-finding missions and the templates of other countries. In as much as it is good to have those conversations, we are far ahead from most countries. And if you look at Guyana, when ExxonMobil drilled the Liza well in the Starbrook block, at that time, only 40% of the adult population in Guyana had a primary school education. And that's not where we're starting from at all. And, just driving home that point that there's so much that we've built on, and that we need to lean into that a little bit more and be comfortable with the fact that our story or our local content policy should be written from where we're starting, and that, most countries would have chased employment. We should be able to chase ownership and operatorship, very confidently. And then maybe just a point of clarification so I don't get in trouble with Eduardo. I understand that, a welder certified in Namibia is a very skilled welder, but welding offshore requires an international codification under international pressure standards, because a defect, such at deep waters, is not actually a defect, it's a catastrophe, right? But that just points to the fact that we do have the skill, we're just missing the certifications, and we can do that quite quickly. And even within the platform supply vessel space, which was clearly indicated on the industrial baseline study as something that's missing, we have people in our team who have coordinated global technical surveying teams, but you know, an IOC would not give us preferential treatment if we were to bring an asset into country or before we bring an asset into country. So it makes it a chicken and egg issue in terms of how can we really participate? And Roland sort of drove that point home that most of the contracts have already been signed before we can even participate, when we do have Namibians who can participate at that level. So we should be chasing it a little bit more and imploring Carlos and the government to back up that local content, because we're seeing it a lot that it's easier and respectably so for IOCs to go with a contractor that they've worked with before versus going with us locally. And we get that question a lot, right? As the tenders are coming out, we don't see a local content requirement in this. So, you know, it's easy to pass on a local company and not have Namibians actually participate in something that's valuable for the country.
Great. Thank you, Tammy. All right, yes, go ahead, Mr. Rodriguez.
Tammy, you will never get in trouble with me. Sorry.
All right, thanks for that, Tammy. I think my key takeaway, and I hope I'm not misquoting you, is that as much as there's so much to be done, at least we're starting off better than countries such as Guyana. Now, back to you, Mr. McLeod. From the presentation by Roland, we saw an insert where he indicated that Total Energies have sort of already onboarded all the contractors. Now, one concern that often arises or is raised by financial institutions is that opportunities to participate may only emerge once major financial structures have already been arranged internationally. How is government ensuring that Namibian financial institutions are brought into discussions early enough to build relationships, understand financing requirements, and compete for opportunities rather than being considered only after key decisions have already been made?
Thank you. I want to be honest rather than reassuring. One aspect that we should be very honest is that when it comes to FPSOs, I don't think there's any bank in Namibia that can have that appetite and that capital to write a check for that. I think it will come with time. However, it doesn't exclude that that opportunity can avail itself in the long run. As for the other opportunities around that, that is where the banks can come in, because there's a lot of value that lies in there. There is perhaps issues of warehousing, workshops, infrastructure in terms of equipment that the banks can fund. There's also the issue of using manpower and assuring that the people that are partaking into this venture is serviced by the bank in terms of funding. So there's a lot of opportunities that the bank can utilize at this point in time. What is important is that money is retained in the country. And how money is retained in the country is when the financial sector come together, sits with the operators, with the tier one companies, and understand what is their needs. How is this financial sector able to match and meet, you know, those particular requirements, so that we cannot hear the IOC say that we don't have the necessary expertise, we don't have the necessary opportunities for Namibians here. I think it starts from us as Namibians, as the financial sector that needs to come on board. And that discussion needs to be held ASAP, as soon as possible. And then also, one aspect that we would want also to have in check is to have a local content plan, which kind of checks the operators, the IOCs, on an annual basis, to say that, okay, there's this efforts that has been made by government, there's this efforts that been made by the financial sector. What are you, as the IOC, what are you doing in order to progress this process of bringing Namibians aboard? And I think that is the only way that we can keep each other honest. Thank you.
Thank you for those brilliant remarks. Ms. Hans, moving on to you. Now, we have heard a lot from the Bank of Uganda in terms of how they've positioned their banking sector to participate.
Yes.
Now, you have quite a lengthy experience serving in the banking industry, and you are quite familiar with the regulations from the Bank of Namibia, and probably your answer speaks directly to my colleagues at the Bank of Namibia. So what are some of the regulatory impediments do you foresee that could restrict participation of the local financial sector?
Thank you very much, Elia. I think the starting point is always not compromising financial stability, as was said earlier. So how do we look at the future and the opportunity without putting at risk the current financial stability, capital adequacy that we enjoy in the sector? So in terms of the impediments, they present, and I think the key thing is it's always the impediment would limit the scale of the transaction, but one has to really look at where relaxations are required, that they actually de-risk the underlying transaction or not. So one of the biggest impediments would be, I suppose, the single obligor or single party limits that do exist, and the capital, the current, I think, 25% of capital. What the examples shared in Uganda are definitely plausible, although I might add, I'm not aware that many banks in Namibia hold too much tier 2 capital. So, but that is worth exploring. I think a few years ago we had a 30% limit that was in COVID, and I think the fundamental question for me is, was 30% really that much more riskier than the 25? But at the same time, so we just probably need to use data to back the to be guided by going forward in terms of these single party limits, because ultimately it is about understanding real risk and whether there is a substantial increase in risk or not if that limit is upped. The other side of it is obviously I think one of the impediments is the mismatch, the asset liability mismatch that exists. So typically banks are funded short and they lend long. So in the context of this particular industry, one would have to look at that mismatch, as well as what was mentioned earlier by David is looking at the FX mismatch, where Namibian banks and Namibian companies operate in Namibian dollars, and typically your contracts with IOCs would be in foreign currency. So one would have to understand and explore opportunities along those lines. In terms of skills, I know a lot of banks are really ramping up their skills. And as was said also is we're not departing from a zero base. So a lot of the skills in terms of complex finance are not, or some of the transactions are not unknown to Namibian banks. I suppose what complicates it is the scale and the complexities that go together with the oil and gas industry. So definitely there are impediments. Those impediments are linked to regulations, but we should never compromise financial stability. And as was said earlier by Honorable Tom Alwendo also is, it must make sense. The fact that it's an industry that we would want to see grow does not take away our responsibility from ensuring that the underlying risk is absolutely acceptable. So these are some of the impediments but at the same time, when one looks at relaxations, you have to look at it in the context, as I said earlier, that the risk is actually reduced by whatever structures. David mentioned using off-balance sheet structures. So where they do reduce the risk, there is an opportunity to look at the risk weightings of assets in that context. Thank you.
All right. Thanks. Just a quick follow-up on the single obligor limit, because I
Yes.
think that's quite key for our industry.
Yes.
And so the question becomes, the banks will probably advocate for increasing the limit to
Yes.
give them that room. The regulator would want the banks to restrict dividends, bonuses, so that they can grow the capital base. So how would you balance the two?
Yes, it's a tricky thing because I agree with you. I would probably have given you a slightly different answer a year ago, but I think it's true. Everyone has to have skin in the game. If you look at the sheer size and quantum if you look at the banking industry in context, and I have figures, I think, from Q1 of 2026, where the total assets are about 195 billion Namibian dollars. The total industry is compared to the opportunity quite small. So the first question I had to ask myself is, okay, when you look at the limit, the single obligor limits, does a 5% increase, in fact, even enable more, given the size and quantum of the industry? So one has to look at that practically and say, does a 5% increase make a big difference? On the other hand, yes, capital is generated. I must say I'm an advocate for banks being profitable because capital is generated through profits, right? That's not a popular thing to say, but it's the truth. So building a sustainable banking system or financial system does require institutions that are financially sustainable. But the generation of those profits should go back into the capital pool. And that's where your point is absolutely valid. So what does that say to banking institutions around skin in the game for the long term? So how much capital is then retained to reinvest, to increase the capital pool so that 30% or 25% of tier one capital becomes a bigger ticket size? So there is a partnership and I would support that.
Thank you for that, Ms. Hans. Ms. Itembu, moving on to you. Many banks assess business primarily through financial statements and collateral requirements. So from your perspective, operating in the maritime services industry, what do you wish financial institutions better understood about the business models, cash flow cycles, and financing needs of companies seeking to participate in the oil and gas supply chain?
Maybe I'll keep that one short and say that the 60, 90-day payments are the death to the SME. And so that's something that really needs to be considered because the cycles are just different considering the global planning and strategy that goes into building IOC's budgets over the year. So I think that's the biggest one that I would focus on as an entrepreneur because the payment cycles are pretty lengthy.
Thank you for that, quite straightforward. Mr. Rodriguez, on to you. So given your global experience in the energy market across the globe, basically, what distinguishes countries that have successfully integrated their domestic financial sector into the oil and gas value chain from those that have not? And what lessons should Namibia adopt early on before the industry reaches full potential?
Yes. I'm not going to get in trouble highlighting countries, all right? But I think to be safe, I think Norway is a clear example of what they've done it right, and what they've done with their sovereign fund and how they managed, how the country transformed completely, right? Curiously, where before that, the fishing industry was the biggest industry, and they were able to develop the offshore, which usually those two don't go together, and they made it coexist. But clearly, good policy is the key priority. So I think benchmarking, which Namibia is doing extensively, we have a representative from Uganda clearly showing a pathway, but you've also done it with emerging oil-producing countries such as Guyana. You've done it with Nigeria. You've done it with Angola. So I think the homework is being done. Bank of Namibia constantly has gone to Norway to understand the management of sovereign fund. So I think Namibia is doing the right homework, which is benchmarking. But I think you cannot copy a country because each country is different and they have a reality. And I do think that you have, as Namibia, the right opportunity to decide what you're going to be. And usually, if you follow the basic principles of what attracts capital and what creates growth, which most countries fail to do for different reasons, but Namibia has that opportunity to decide what you want to do based on the benchmarks that you've done, but following the basic principles. That is not rocket science, but so what is that? You already have a robust financial system. Can I call you Rolly now? You changed my whole perspective of Roland. As Roland was saying, there's money. There's $20 billion in savings in Namibia. That's that's two offshore projects, right? Now, is that the right investment? So clearly, you have a robust financial system. You have private banking. You have clearly a very good central bank, a very serious institution. You have wealth management. You have stock market. You have already a financial system. So you have the tools in it, right? But the basic principle is here that we have mentioned, it is risk, right? How do you manage risk? And that's something that is going to be critical for the banks because as anybody that has gone look for a loan is not easy, right? But if you have the basic principles of an economy, which is that capital markets required is you gotta be competitive, right? If Namibia attracts capital, is competitive. It's better to invest in Namibia than in South Africa, than in Nigeria, than in any other countries. You have to maintain the basic principle is, am I more competitive than the rest? To Namibians that invest in Namibia. Because you can have also that you make money in Namibia and you take it out, right? That happens. But you have to create a system that doesn't force, but it attracts. I cannot force my wife to be in love with me. I have to earn it, right? And that's the basic principle of investment. You have to let capital flow, as it was one of the presentations. Let capital flow. Capital markets, at the end, they have a clear, which is return on investment. So if you have that, you don't have to worry about the rest because the rest will come. But if you're forcing things, then it becomes more riskier. And the risk is something. So what do we like? Competitive. We like transparency as well. We like things to be transparent. Things are as they are. There's no tricks on it. It's transparent. It is predictable. Predictability. We like predictability. We like to understand what lies ahead. Also, as well, we have to have clear rules of the game, right? Because here, especially in the oil and gas sectors, especially the offshore one, that you have to put all the money up front for a development. You have to build the FPSO, you gotta buy the stuff, you gotta, before you produce the first drop of oil, you have 4 years to do all that. In addition to what you have already investment, you need to have clear games of the game. I entered this game under these rules. Let's agree that, those rules will be maintained through the course of a long-term investment. So that's the basic principle of this industry, as well as anything that is financing it. Because if we were talking about the supply chain, if local banks are financing supply chains, but those principles are not maintained, then the whole risk goes to everybody, okay? But Namibia is doing a good job, I think. Going again, are we having the right discussions? Yes. Are we having do we understand what are the challenges? Yes. Are we discussing the challenges? Yes. But we need to just have those principles clear. And one anecdote, so compliance is a big part of our industry as well. Transparency and compliance is a big thing. But I have a very nice anecdote that happened with a functionary of the Bank of Namibia. We were in a dinner. And we're talking about the oil and gas industry, and I was explaining because she was in that process of understanding the industry. And then you can ask me any question you want, just shoot. And then she said, "How do you deal with corruption?" It blew my mind. But that tells the level of thinking that is going on in the Central Bank of Namibia, Bank of Namibia, that this is a topic of discussion. Out of all the questions that she could have asked, what is an FPSO, what is the subsurface, what is the permeability, what is flow rates, what is all this kind of thing, how do you deal with corruptions, right? For me as an investor, that tells a lot about the DNA of a country, and that's competitiveness.
Yes. Thank you,
That's
Mr.
reputation.
Rodriguez.
So those things are key, and they are the basics to attract investment so everybody can benefit.
Thank you so much for those views. Indeed, a critical question. How do you deal with corruption? Taimi, quickly in less than a minute. Now, you had the opportunity, through your experience working for ExxonMobil, to sort of understand the varying interests of the government, the local businesses, and the operators. So beyond access to finance, are there any policy, procurement, contracting, or institutional challenges that you believe deserves greater attention from government, regulators, and the industry to enable SME participation in the value chain?
Yeah, so I think having worked in one of the largest investor-owned companies in the world, you learned very quickly that capital moves where governance and government is credible. But I think maybe just to switch your question up a little bit, I think what's really important is to have the right investor and the investor that is as dedicated to the people in that country as it is to the resource. And this is, and I can only speak from ExxonMobil's point of view and having been within that company, is the marriage between Guyana and ExxonMobil was exponential in the sense that not only was it the fastest sort of discovery to production in history, but it came with a lot of quick investment into the country that was most likely regulated by the government. So 2015, you have LISA. 2017, you already have a up and running Center for Enterprise Development, making sure that local content is participating very, very early on, which is a story that we're not, or the narrative that we're hearing here is that we shouldn't be participating so early on because of the ticket sizes and et cetera. But I think based on the conversations that we've had here today, the innovations are there and we can make it happen. Guyana alone, I think within the first half of this year, local procurement cumulative numbers were at 2 billion, right? Which is something so monumental for a country of that size. Today, ExxonMobil is putting in, $100 million investment on STEM education, which is really investing into those offshore, very technical skills. Again, it's great that we, will provide or will support hospitality and logistics and very much of the administrative roles, but for us to really and truly be globally competitive, we need to think with the mindset that we are building industrial capability, and that industrial capability will only really happen at a magnitude when you look at the offshore services, and that we should be comfortable enough to participate in those. And again, just sort of honing back onto being very deliberate and intentional about your investors. I mean, I'm an example of local content based on, I would say, my class since discovery. ExxonMobil was the first company in this country to ensure that you have a dedicated public and government affairs manager. I was the first within my class to be pulled up to deputy country manager, and that came with very strong local content regulations that were driven, I believe, very much by Carlo. And I was the first one to move out and, I have a global executive track with the company. Again, just goes to show the intentionality of investors and making sure that we're pushing for local content first.
Thank you, Taimi. Indeed, early participation for local content. Closing remarks, starting with you, Mr. McLeod. If we were to reconvene 5 years from now in this room, what would success look like? So what tangible outcomes would convince you that Namibia has succeeded in integrating its financial sector into the oil and gas value chain? 1 minute, please.
Yeah, thank you. I always like to be very brief and pragmatic. I think what is success for us is still a very long shot for us. We have the policy, the local content policy, which was approved in principle. And within the local content policy, you have what we call the implementation plan that basically guides us as to how this policy should be affected. But it doesn't end there, because we would want to translate the policy into the bill, which is already before Parliament. And then once that bill is approved as a substantive act, then we would want to set up regulations through the regulator. And through the regulator, through the regulations, you set up certain parameters to say that for X amount of job for this category, it should be either 100% Namibians, it should be 50%, etc., etc. So you basically specify how you would want this sector to grow. as a Namibian sector. And then once that is done, now you as the regulator, you have now the task to monitor the compliance thereof. And once that is done effectively, during a certain period of time, whether it is 3 years, you can then do a evaluation to determine whether the efforts that you have put into this is gaining some fruits. Because at the end of the day, you need to account to the citizens from the government's point of view. But I also want to highlight that counting jobs is also not just an issue, because 100,000 jobs, which is temporary, doesn't mean anything at all in terms of local content. What you want to see is you want to see capital coming and remaining in the country. You want to see it go through the financial sector, through the banks. You want to see businesses moving. You want to see industry starting. So that is basically, at the end of the day, what you want to envisage as a country, as success. And ultimately, I would want to say in a nutshell, how would success look like for me? If I have to sit where Adriano is sitting, that would be success for me. If I am the country manager of Shell, that would be success for me. Thank you very much.
Thank you. A round of applause. Ms. Hans, over to you.
Yes, just some closing remarks, starting with, I love what Taimi said in terms of the types of partners and the types of capital. I think we live in an era where conscious capitalism is encouraged. If we look at the types of investments we made, the responsibility as corporate citizens that we carry. So definitely do support and would like to just emphasize what she said as a very important part of what success would look like for us in future. And also just from a banking sector and financial sector perspective, I think waiting for invitation is not a strategy. So definitely, as has been said, active participation is required and not just dancing on the periphery. But that also requires that the IOCs and government make sure that financial institutions are involved from the outset. So there needs to be some form of inclusion from that perspective as well. And ultimately, success really means for me that the oil and gas catalyze broader capital formation in our economy, diversification that we spoke to earlier, as well as long-term productivity for Namibia. So really broad-scale success and not just in an isolated sector, but the development of our people and transformation of our society would ultimately be the acid test of whether we've succeeded or not.
Perfect. Waiting for invitation is not a strategy. Mr. Rodriguez, closing remarks.
What success look like?
The question?
Yeah.
So it's just in terms of if we are to reconvene 5 years from now in this room, how would success look like that we have incorporated?
Success would look like a industry that is a country that is so thriving that everybody wants to be here. That you look at the Atlantic Ocean and then you see seismic boats, you see rig activity, you see development, you see oil production, you see optimization of blocks, you see a sure and clear rules of the game, and that local companies keep to grow, and you get that inertia of continuous success, and clearly very well managed by the Bank of Namibia with a sovereign fund, investing in education, investing in infrastructure, investing in health, building the country, and that you are the outlier of Africa. And that Mr. McLeod is not a country chair of Shell in Namibia, but a country chair of Africa. Because something that you have to understand, this is an international business, and I want to see success. That as I see Angolans here, as I see Nigerians, the head of Shell that decides where the money goes is from Nigeria, right? Mm-hmm. And that's the thing about this industry. It's not countries, global, and that's what we have to think. Eventually, we will have Namibians somewhere else, right? Well, Taimi went out, but she loves her country so much that she came to do entrepreneurship. But that's what success looked like. But for that, you have to be attractive, be competitive, and be transparent.
Thank you, sir. Taimi, your closing remarks, please.
Very simple, that Zephyr Marine Services is a global company. So such that we're not just operating in Namibian waters, but we're also tendering with Shell in other parts of Africa. That's what success would look like for us.
Sweet and brief. Thank you so much. Jason, if you can just allow me 5 minutes for the Q&A, right? No. There's no time. All right. Thank you so much. A round of applause for my exceptional panel.
Indeed, ladies and gentlemen, I would like to extend our appreciation really to Elia and the panelists for the openness and the quality of the discussion. And with that said, and in the interest of time, ladies and gentlemen, I think we have now come to the end of the program. And at that juncture, I would just like, it's really an honor for me to invite the Governor of the Bank of Namibia, Mr. Epson Wanguta, to deliver the closing remark. Governor, the floor is yours.
Thank you very much, Jason, the Director of Ceremonies, the Deputy Governor of the Bank of Namibia, Ms. Leone Dan, our former Minister of Mines and Energy, and also the former Governor, Mr. Toma Luendo, the senior representatives of government who are present here, the board members of the Bank of Namibia, the management of the bank, the CEO of our regulator, sister regulator Namfisa, together with the two deputy CEOs as well, the CEO and the managing directors and senior representatives from the banking sector and all the captains of the industry who are present here, the senior representatives of the oil and gas sector, the esteemed international guests who are present, distinguished speakers and presenters, members of the Fourth Estate, ladies and gentlemen, a very good afternoon to all of you. I know that I'm standing between you and lunch. A very good afternoon. On behalf of the Bank of Namibia, allow me to thank all our speakers and participants for the quality of the discussion and the openness, the candidness and frankness, and the practical insight shared throughout the day. Today's engagement has clearly confirmed that financial sector preparedness is part of Namibia's broad national preparedness effort. Oil and gas developments have a bearing on the soundness of the financial system, on foreign exchange flows, domestic liquidity, credit condition, and the resilience of the Namibian economy. The first major message, ladies and gentlemen, from today is that participation must be matched by capability. The oil and gas value chain can create financing opportunities across various adjusted sectors, such as transport, logistics, engineering, accommodation, equipment supply, technology, infrastructure, and other professional services. Therefore, financial institutions will only participate meaningfully and sustainably if they understand the underlying commercial structure and risk, as it has really been pointed out by our speakers. Oil and gas related financing may involve substantial capital requirements, It may involve long investment horizons, complex contracts, foreign currency exposures, and specialized technical skills. This naturally will mean that banking institutions and other financial institutions will require appropriate expertise, will require governance and risk management frameworks. And ultimately, participation must remain consistent with institutional soundness and financial stability. Second message. Second message is that financial sector readiness extends further than banking. Namibia has a large non-bank financial institution that administers significant long-term savings. Commercially sound opportunities may arise for pension funds, for insurers, and investment managers to support infrastructure and productive investment associated with wider energy economy. However, the developmental importance of these resources does not diminish the fiduciary duties owed to pension fund members, the policy holders, and also the investors. Investment decision must remain grounded in proper due diligence, must be grounded in diversification, in sound governance, and in appropriate risk-adjusted returns. This also clearly underlines the need to deepen Namibia capital markets. The bonds, the infrastructure instruments, the private capital structures, the guarantees, as they were mentioned, the blended finance solutions can broaden funding sources and reduce excessive concentration on commercial bank balance sheets. Ladies and gentlemen, the third message concerns meaningful local participation. Local participation should not be measured only by ownership percentages or contracts awarded. It should also be reflected in a sustainable Namibian enterprises, specialized skills, sound financial management, strong governance, and competitive local supply chains. The financial sector can support this objective through suitable products, active advice, and by helping business improve their bankability. At the same time, national importance should not remove the need for disciplined credit assessment. Again, I think the previous speakers have really underscored that. A commercial opportunity is not automatically a bankable proposition. Business must strengthen their capabilities. The industry must clarify procurement and financing requirements. And financial institutions must respond while preserving prudent underwriting standards. Fourth message is that regulation must remain forward-looking without becoming permissive. We heard that message clearly from our colleague from Uganda. The Bank of Namibia clearly recognizes that the financial system must evolve as the economy changes. New industry create new products, financing structure, and risk profile as well. Regulation and supervision must therefore remain responsive, must remain proportionate and informed by market developments. An enabling regulatory environment, however, should not be interpreted as a relaxation of prudential standard. The complexity of uncertainty associated with oil and gas activities make strong governance and risk management more crucial than ever before. As a central bank, our responsibility remains to safeguard the stability, the integrity, and the resilience of our financial system, while at the same time taking the responsibility to innovate and support sustainable economic development. Supervisory attention will need to still consideration the foreign currency and liquidity risk, large exposures, cross-border financing, operational, environmental, and climate-related financial risk, and interconnectedness across the entire financial system. We must also remain alert to macro financial effects on domestic liquidity, the credit growth, and the asset prices and foreign exchange demand, and ensure that our framework remain fit for purpose. Our theme for this year, we say that we want really to make sure that we are marching with a very clear purpose while aligning the central bank for the new economy. And this is exactly what we are trying to achieve. Another clear conclusion from today's discussion is that coordination will be essential. This is not a one-man show. This is not a one-institution show. This is a collaborative. This is coordination. Oil and gas used to be known as a technical area, possibly exclusively being managed by the Ministry of Mines and Energy, and possibly NAMCOR as well. But where it is now, it requires all the parties to come on board. In terms of information sharing, in terms of ensuring that the benefits that are accruing from this industry are widely shared. For us as regulators, coordination is essential because risk may migrate across institutions and across sectors. Common exposures and interconnectedness reinforce the need for close cooperation between the Bank of Namibia, between our sister regulator NAMFISA, and the Ministry of Finance, and other relevant authorities as well. Today's seminar should be the beginning of a more structured process of preparation. It shouldn't be the end of the conversation. It should not be viewed as a talk show. The bank will consider the insights and recommendation shared today as part of its continued engagement with supervised institutions, with the regulatory counterparts, with government, and with the entire industry. We will also assess where further supervisory guidance, capacity development, and coordination may be required. Ladies and gentlemen, as I'm going to conclude, allow me to express our appreciation to the Bank of Uganda and to the Governor of the Bank of Uganda for allowing our colleague David Kalyonga to be here with us, convey our sincere gratitude to the Governor. Countries entering the sector face common questions, although each must respond with its own economic, legal, and institutional context. learning from the fellow African central banks helps us to identify issues requiring early attention and also areas in which capacity must be developed. Mr. Kalyongo, we sincerely appreciate your contribution and ask that you convey our gratitude to the leadership and colleagues of the Bank of Uganda. In fact, we have really put in motion the MOU that we have signed recently now in June. I also want to take this time and express my gratitude to our former governor, minister, cabinet minister, Mr. Tom Aluendo, for sharing his valuable insights and experience. I once again thank all our speakers. Roland, really want to thank you. Eduardo, really want to thank you. Mr. McLeod, we want to thank you. Baroness, thank you very much. Really want to thank you. Tammy, thank you very much for your participation and for your contribution. Finally, I wish to commend the team at our bank who have really worked very hard behind the scene to make this seminar a success. When we started with these initiatives of having seminars, I did not imagine that the outcome is going to be like this. Really, you are completely going beyond what one expected. And I really want to thank you for that. This seminar was just a precursor. Soon, as part of our annual symposium, we are also going to have to tackle the same topic that will be looking at assessing the options of choices that are available to the country in this phase of pre-FID. That is also going to be a topic for the discussion at our annual symposium, and how we can make those choices to ensure a sustainable and create a long-term value that will be emanating from oil and gas sector. So prepare yourself for that as well. Again, we will be making sure that we will be compiling a compendium of the findings of these seminars. We will make sure that we will share them with the relevant authorities wherever they are. And we will, as a regulator, we will be taking with our regulated populace and agree and see that how best we can support this sector moving forward, while at the same time, we will not just be carried away by oil and gas. Make sure that we grow the economy sustainably in its broader sense. With this, I thank you very much.
Thank you very much, Governor. Ladies and gentlemen, the seminar is now officially closed. On behalf of the Bank of Namibia, thank you again for your participation and your constructive spirit, which you have engaged throughout the proceedings. You are invited to lunch. Apologies, we have taken 15 minutes of that. We are invited to lunch to, the restaurant name is Eliza Restaurant. It's at M Floor. I would like to ask the speakers and panelists to just remain behind for 2 minutes. We'd just like to take a picture or two with you. But the rest of us, please, let's continue the conversation during lunch, given that we did not have a proper Q&A session, so we can continue that conversation during lunchtime. Thank you very much.